What's going on, crypto fam? Welcome back here to the channel. Haven't done a little live stream like this in a little while. There hasn't been some crazy things to really, warrant a live stream. But today is a big day. The overall market this week going to be very interesting as we watch a lot of things unfold. Of course, Trump meeting with China today while he's in London. This kind of starts the negotiations with trade talks between the United States and China. But then we've also got some other things happening. SEC Roundtable is coming up live here in about 20 minutes. We should be able to catch some of that. We'll see how the market responds to that. On Wednesday, we have CPI data coming up, and Bitcoin has been on a nice little uptrend. Bitcoin's been on a nice little uptrend starting yesterday. To close out the weekend, Bitcoin started ripping. And really, you go back a few short days ago, Bitcoin dipped down to 100,000. A lot of people were kind of shaking in their boots thinking, this is the start of an epic collapse of Bitcoin. And as we've seen time and time again, Bitcoin and crypto tend to do exactly what you least expect when you least when you unexpect it. So expect the unexpected. Easy for me to say in crypto, right? And that's exactly kind of what happened and how this has played out. But definitely an optimistic week. A lot to look forward to. Let's see who we got in the chat. Adam is in the house. What's going on, bro? Let's get this alt rocket off the ground. Yeah, we kind of addressed this today during the Crypto Breakfast Club, our X space that we do daily. If you guys don't follow me on X, make sure you guys do. You can find it in the links down below if you're on YouTube. Just search me up. You'll find me. There are some, other accounts trying to, say they're me. So make sure it's just like the right one. But make sure you guys are following me over there because we had a great discussion this morning about all of this, man. We have so many great minds that come in there. I learned something every single day. So many different perspectives, but we were talking about altcoin season a little bit today and, kind of addressing it and basically saying that, hey, we need liquidity to come back to the market. And really, in order to get retail fully back in the swing of things and have a sustained rally, right? Where not just pockets of the market are moving. We need liquidity to come into the market and stay in the market. We need a better macroeconomic environment. That's really what we're missing, right? And I think we'll get that when interest rates are cut, when they start printing money again. What's up, Ridge? How you doing, man? Good old Jay's in the house. Roberto's here. What's up, man? Roberto's one of the OGs, man. Shout out to Roberto and Trav. I see you, man. What's going on, brother? Let's go. This week's looking good. Super optimistic about this week. What's up, Foggy? How you doing, man? The ripping and the tearing. What's up, Roberto? How you doing, man? XRP. Will Pepe go parabolic soon? A lot of it hinges on Ethereum. I think when Ethereum rips, though, Pepe is going to have a nice day as well. Ripping and tearing. What's up, Daniel? How you doing, man? XRP, let's go. River Villa, what's going on? Yeah, we'll take a look at XRP. And this whole SEC roundtable today is big for XRP and has crypto implications. Obviously, a lot of the attention and focus is on stablecoins right now, but I think that, shift will happen once stablecoin regulation is put in place. I think it's then all eyes on, ETFs and basically a full framework of what crypto is going to look like in the United States moving forward. I think that's the big thing we're really waiting on. What is exactly this all going to look like underneath this new regime? We know that they're opening the doors up to crypto, but the specifics of all of that, what does that mean for our assets that we hold? Should we be prioritizing certain sectors of the market, certain cryptos, all of that, right? We have some indication there that, shows us some things, but we don't have, full clarity just yet. M2 money supply is also a nice indicator that keeps going higher with Bitcoin holding above its key support levels. It's a good point, Foggy. Definitely a good point. Bitcoin up over 108K. XRP at 227 right now. Love to see it. The rest of the market pretty solid here. What happened to Will Fix? I don't know who that is. Hello from Chicago. What's up, Mary? XRP to the moon. SHIB, same thing, man. Once Ethereum gets going, I think that capital will flow into SHIB too. It's been a while just working still. I hear you, Roberto. Keep grinding, bro. You know how it is. It's what you got to do, man. Andy's here. What's going on, Andy? Lemmer from South Africa. What's up, Lemmer? What's shaking, y'all? Oak Woody, what's happening? If XRP is going to revolutionize the financial system, why is it still at $2? Well, keep in mind, man, it was at 50 cents not that long ago. Okay. And it's been held down in this 4-year lawsuit. And I think that's the big key takeaway here, Charles, is finally we're getting away from that. XRP has been able to flourish outside the United States the last 4 years, in certain pockets of the world like the Middle East and Asia, but it has not been able to flourish in the United States yet. And I think that's the big thing in the United States. Where does all the money lie and all the power and all of the, movers and shakers? It lies within the traditional banking system. That is who pulls the strings. And as we make this transition from TradFi to DeFi, or at least bridge the two together, and create a tokenized world, that's where I start to think, we're really going to see the value of Ripple, their stablecoin environment, XRP for cross-border payments, and then don't forget about tokenization. That's really a big area where I think XRP can flourish, right? That is not necessarily talked enough about. I think we talk a lot about cross-border payments and remittances, but not so much about the RWA sector. And Ripple's a big player there. They had a huge partnership just announced recently within the last couple of weeks, a couple of them, as it relates to tokenization and utilizing, the Ripple ledger, the XRPL. So that's huge. With Dubai tokenizing real estate, I think they're starting with $16 billion worth there, and that's just a start. And so XRP is a piece to the puzzle that's going to help revolutionize this financial system. They're certainly a big piece, and I think that's already represented in how big they are. I mean, look, they're $134 billion market cap. And they've been held down from flourishing in the world's biggest economy for 4+ years, So if you take all of that kind of stuff in consideration, I just think we're early still. We're very early days still, and all of these things that are happening in the background, they're moving us in the right direction now. This SEC roundtable, that's coming up. They're trying to basically get to the bottom of crypto and find a way for it to flourish. This is what we were talking about, Crypto Task Force Roundtable. I believe this is the last one, DeFi and the American Spirit. They do have the live stream up now, so we'll listen into some of this during the actual event. We're going to hear from Paul Atkins, which I think is obviously the new SEC chair. Hester Pierce is in there as well. This is kind of the breakdown of some of the panelists, and we'll sift through some of this as we go through the live stream and listen in and see if we can glean anything from it, guys. But yeah, I think it begs the question. It's not a matter of if, but when, right? And I think these sort of things are playing themselves out. It's not going to happen overnight, but the fact of the matter is these conversations are finally being had, right? And they're trying to move the ball forward. ETH just had a nice candle. What's up, David? It's a hot meme coin right now, Vin. I like Doge still, Mary. I mean, it's been quiet for a while because retail has been kind of out of the game, but I still think Doge it's a household name, and I think it'll do extremely well overall here. Guys, if you could hit the like button for us, obviously subscribe to the YouTube channel. If you're watching on Rumble, we are live streaming this on Rumble, YouTube, and X. So shout out to everybody on all three platforms. We just entered a great partnership with Rumble. Super pumped about that. So we'll be streaming there more regularly. Right now, about 3 days a week, but that's like minimum. And so we'll be doing a lot more lives with them, and they're really trying to, push the envelope when it comes to crypto content over on Rumble. So super excited about that. What's the biggest catalyst for you? ETFs, ISO, or something else? Well, it kind of depends. I think ETFs, if you're looking at it from the institutional side, is certainly big, but also is just overall regulation, overall clarity along with ETFs. The ISO narrative then I think follows after that. Once you have all those sort of things in place, alongside stable coins, you're going to need that in place. But then from the retail side is we need liquidity. We need liquidity back in the market. We need the money printers back on. We need rates cut. Those sort of things. So there's quite a few, Hector, like that kind of play into all of this, I think, right? It's not like one thing or the other. Is Levi back up yet? I'm not sure, man. It's crazy. Hopefully he gets back up and running very, very soon. What's up, Edwin from the Netherlands? How you doing, man? Don't forget, we only have 7% invested into crypto. Exactly. Great week getting on Rumble. Thanks, Bernie. Great work getting on Rumble. Appreciate you, man. Thanks, buddy. Yeah, no problem, Mary. So yeah, we do have the live stream set. This thing's set to go from 1 o'clock to 5 today. So I don't know how long we'll be live. It just kind of depends on what's going on in the market and kind of what's moving, what's shaking. But I did want to kind of pop on live. We had that going on, so we'll definitely take a listen to it. Look at BitTens there. BitTens are towels on a tear right now. I really liked it at 350 when we started reversing within this last 7-day period. We dipped down right here to like 350 range. Look at that. Great bounce off 350 all the way back up to 414. Tau looks really nice. Good afternoon from Toledo, Ohio. That's awesome, man. Coming in on Rumble. What's going on, Big John? How you doing, man? How are we doing? We are getting set for this live stream, set to start in about 9 minutes, give or take. So we will listen into to this and see what we can glean from it here in a little bit. Crypto Task Force Roundtable, DeFi and the American Spirit. They are coming live from Washington, D.C. today. And let's take a look at the overall market again, though. Let's take a look at some of the other movers here. SPX, somebody mentioned that earlier. Kaya has been moving quite a bit today. A couple other meme coins. Fartcoin, man. Fartcoin's up 8+%. Hyperliquid looking very good. Walrus within the SWI ecosystem looking solid here. Virtuals bouncing up a little bit as well. SWI itself is up 4%. Native asset. It's up at 337. I put a video out on the YouTube channel today, SWI or Solana, kind of talking about, there's some similarities and kind of comparing the two right now. Really, really like what SWI has offered the market thus far. And I do think they've got, a nice little runway and path forward here this cycle. They've got a lot of VC backing, with the group coming over from Facebook and launching this thing. But they've got a lot of retail interest too. And I like that. That's kind of what I'm looking for right now in the market is I want to see those assets that have the retail eyeballs and the institutional's attention, the institutional demand, right? There is no use case for Fartcoin. There is no use case for a lot of these meme coins, man. It's crazy. But hey, they reach massive market caps and they move. So, I mean, you could take advantage of it. But just be careful, obviously. It's all timing when you're trying to trade these altcoins or take a little profit off the table. It's always timing. And people will tell you it's easy. It's not easy. It's not easy to time the market right. But, that's why for me, I have a Bitcoin strategy. I accumulate Bitcoin. That's kind of my number one strategy. Keep in mind, guys, Bitcoin makes up a huge percentage of the overall crypto world, makes up 64% right now, right? And then it's like, okay, from there, which altcoins can you find? Can you find some diamonds in the rough, make some short-term plays, maybe hold some things within this cycle, things like that. That's kind of my thoughts, at least. So I don't think anything has started here. Yeah, roundtable set to begin at 1 p.m. So we have it running, we have it live. So we'll see what's going on there once we do get, you know, this thing up and rolling from the SEC. What are you guys most interested to kind of see the rest of 2025? I'm curious to hear your guys' thoughts. I'm curious to hear your guys' thoughts on the rest of 2025. What are you most looking forward to? How long do you think Ondo will take off? Yeah, I mean, a lot of this comes back to the institutional side. You know, they're a huge tokenization play. I think, you know, it's more of a longer term play for me. I did start accumulating Ondo like under $1. I really like it because they're, you know, teamed up now with BlackRock, and there's ties there to JP Morgan Chase. And then they had a partnership with Ripple go through. So I think there's a lot to like about Ondo for sure. In terms of, you know, when nobody knows. It's anybody's guess, right? But I've got my targets, and I talked about it in a video yesterday. You know, XRP and Ondo, their partnership, how it's a big deal. Ondo now developing, you know, their own layer 1 blockchain. Ondo Finance and Ripple have partnered to bring Ondo's tokenized US Treasury funds, OUSG, to the XRP ledger. And this is going to really allow institutions to have access to tokenized RWAs. And obviously, this partnership with Ripple, Ondo is smart because it's going to enhance liquidity and efficiency within these markets. And OUSG will be redeemable with the RLUSD, which is Ripple's stablecoin. XRP pump. Let's see. Are we getting a little XRP pump? Let's see. Let's take a look here. This is the weekly chart, but we'll go into the 1 hour here. 1 hour look here on XRP. Looks pretty good. Did get up close to about 230. But we came down and you know, got close to that $2 level and bounced off it pretty nice. That's a big psychological and technical support zone, that $2 level. So it was good to see us jump up from that. I'm mostly looking forward to sprinkles on my ice cream. Nice. Crypto regs is going to be the catalyst that sets us free. What's up, Rudy? Yeah, man. Regulation is going to be a big one. China-US trade deal. Once that tariff is removed, markets will boom. I do think that can definitely help. Yeah, I mean, it's been trading sideways for a while, but you know what? I like that. I like that sideways action. The longer the consolidation, the bigger the breakout, right? The longer the consolidation or trading within a tight range, usually the bigger the breakout we see once things do kind of come to fruition. So I'm okay with seeing XRP kind of trend sideways. Yeah, it's a little bit boring right now in some respects, but I'm okay with it because I kind of know what comes with that, right? With that lack of volatility or trading in a tight zone, you're going to get that big breakout eventually. Crypto doesn't stay boring for very long. That's the beautiful thing, right? Getting out in a timely and satisfying manner, yeah, it's always key. Ripple's RippleNet is being adopted, not XRP, not affected XRP's price. Prove me wrong. Well, I mean, XRP does have utility within Ripple's ecosystem. And Ripple is the company. Certainly, Ripple has the technology, but XRP plays a crucial role within that ecosystem. A lot of it is, you know, providing liquidity too. Ondo can move quick. I think so too, David, especially if the institutions come in and back it. I like XLM too. It fits that ISO narrative. Turbo, it's a popular meme coin. It's been held down a little bit, but still it's hung in there pretty nice. When do you think XRP will hit 3 again? Again, it's tough for me to give you an exact date. Nobody knows, but I mean, a couple of things we're looking for. You know, XRP has flipped bullish. We did knock out, and stay above the EMA, the SMA 200 at 235, $2.35. That's the simple moving average 200 day. That could be a nice catalyst, and that could open up some opportunities for XRP's price to go higher if we can get up there and stay above that 235 zone. So what's going on, everybody? How we doing? We're getting a bunch of people in here. Guys, make sure you hit the like button, subscribe down below. Awesome to see so many people hanging out with us. We're learning, grinding, and hanging out in this crypto space together. It's always a pleasure to have a bunch of people in here with us, and it's great to see the enthusiasm, the excitement, and to think just how early we are, right now. I mean, it's that's what really excites me. We're super, super early still. Legacy, a lot of people will tell you it's a different kind of environment now with ETFs. Some people will say, the 4-year cycle still exists. I think it's a mixed bag. We saw ETFs really throw the market for a loop, and I'm not going to say the 4-year cycles are a thing of the past, but I will say that ETFs are changing the market structure in crypto dramatically. And right now it's Bitcoin, but eventually I hope it'll be a lot of other assets too. Ethereum already has their ETF, but we're waiting for some other big ones. Obviously, XRP has a bunch of them filed. Solana, SWI, HBAR, these type of assets. I think once all of this, the good part of this market is open and available to the institutions who want to get in by way of ETFs, then we're going to have a whole nother, thing to talk about. This market's changing is really what I'm getting at. The whole market's changing rapidly, and a lot of it is, based on ETFs. So they still haven't started yet. They're supposed to start right about now. So we've got it up and loaded here. So when they do begin, once they do kind of come on here, and we'll go live with this, I'll ask for some sound checks, just make sure everything sounds good on that end. So what's up, Charles? How you doing, man? Space, thoughts on SHIB? Talked about it a little bit earlier. It needs Ethereum, man. SHIB needs ETH. That's what we need. Whales will dump on the market anytime. Well, there's a lot of manipulation. Always. There's a ton of market manipulation. It's not going to go away. There's market manipulation every single day in the stock market too. I think it's just felt more in crypto because it's a smaller market. It's just less liquidity. But it's always going to be a thing, BTC, XRP, HBAR, XLM, Ondo, and SWI will dominate the crypto world. I like it, RC. All right, can you guys hear this?
In today's roundtable, we'll spend some time considering where the boundaries lie between financial activity that should be regulated because it is intermediated by centralized entities, and financial activity that does not involve such intermediaries and thus may be outside the scope of the securities laws. We're fortunate to end our roundtable series as we began with Troy Paredes as our moderator. Thank you, Troy, for making a second appearance. And as with each of our previous roundtables, we have a fantastic group of panelists today to help us understand what it means for finance to be decentralized. Before I conclude, I would like to express my appreciation for the enthusiasm that all of you have shown for this series of roundtables and for your contributions through engagement with the task force and through conversations elsewhere with the ideas our panelists have articulated on this platform. I also want to express my appreciation to the amazing team of people from the task force and throughout this building who've put in countless hours to make these roundtables happen. Watching the effort that has gone into planning these events, and believe me, commission processes for planning this sort of thing are as thorough as anything else done at the commission, has more than once made me wonder whether sprint was quite the right term for this effort. I don't have time to thank everybody involved, but I do particularly want to thank my team, and especially Samira Yunus, Ileana Chiabano, Robert Tepley, and Landon Zinda. In closing, I would like to remind everyone that this event is being streamed live and is being covered by multiple media outlets. Accordingly, please be aware that all remarks by Commission officials, participants, and members of our audience will be on the record. In addition, please remember that the participants in today's roundtable speak on their own behalf and that their views do not necessarily reflect the views of the Commission, the Commissioners, or members of the Commission staff. We're now ready to begin with remarks from Chairman Atkins, followed by Commissioner Crenshaw, Commissioner Ueda, and Commissioner Peirce. Mr. Chairman.
Oh, great. Well, thank you very much, Richard, and good afternoon to all of you here in our auditorium and online as well. So it's a great pleasure to be with you all today. Let me begin by thanking Commissioner Peirce and the Crypto Task Force for their organizing of today's event, and Commissioner Crenshaw and Commissioner Ueda for their participation as well. Of course, I very much thank all of you here on the roundtable, for panelists, and our moderator, Troy Paredes, for Commissioner Paredes for your voluntary contribution of time and talent to this mighty endeavor that we're undertaking. So today's roundtable is entitled DeFi and the American Spirit. This is, I think, an apt title because the American values of economic liberty, private property rights, and innovation are in the DNA of DeFi, or decentralized finance, in the movement of that. Blockchains, of course, are a very creative and potentially revolutionary innovation that have us rethinking evidence of ownership and transfer of intellectual and economic property rights. They are shared databases that enable the ownership of a type of digital property called crypto assets without reliance on an intermediary or central party. Instead, these peer-to-peer networks incorporate an economic mechanism to encourage participants to validate and maintain the database in accordance with the network's rules. These are free market systems where users pay demand-based fees to network participants to have their transactions included within a so-called block of data with finite storage capacity. The prior U.S. government administration discouraged Americans from participating in these market-based systems by asserting through lawsuits, speeches, regulation, and threatened regulatory action that participants and staking as a service providers may be engaged in securities transactions. I'm grateful to the Division of Corporation Finance staff for clarifying its view that voluntary participation in proof of work or proof of stake network as a miner or a validator or staking as a service provider is not within the scope of the federal securities laws. As happy as I am over that step, this statement is not a duly promulgated rule with a force of law, so we cannot stop there. The Securities and Exchange Commission must adopt a regulation based on the authority that Congress has given us. Another core feature of blockchain technology is the ability of individuals to have self-custody of crypto assets in a personal digital wallet. The right to have self-custody of one's private property is a foundational American value that should not disappear when one logs on to the internet. I'm in favor of affording greater flexibility to market participants to self-custody crypto assets, especially where intermediation imposes unnecessary transaction costs or restricts the ability to engage in staking and other on-chain activities. Unfortunately, the prior administration undermined innovation in self-custodial digital wallets and other on-chain technologies by asserting through regulatory actions that the developers of such software may be conducting brokerage activity. Engineers should not be subject to the federal securities laws solely for publishing this type of software code. As one court put it, it would be irrational to hold the developer of a self-driving car liable, and here quoting from the court's decision, quote, for a third party's use of the car to commit a traffic violation or rob a bank. In those circumstances, one would not sue the car company for facilitating the wrongdoing. They would sue the individual who committed the wrong. And here just recently, the Supreme Court in a case regarding firearms underlined that particular sentiment. Many entrepreneurs are developing software applications that are designed to function without administration by any operator. The idea of self-executing software code that's accessible to everyone but controlled by no one, and that enables private peer-to-peer transactions may sound like science fiction. But blockchain technology makes possible an entirely new class of software that can perform these functions without an intermediary. I do not believe that we should allow a century-old regulatory framework to stifle innovation with technologies that could upend and, most importantly, improve and advance our current traditional intermediated model. We should not automatically fear the future. These on-chain self-executing software systems have proven to be resilient in the face of crises. While centralized platforms wavered and failed under recent stresses, many on-chain systems continue to operate as designed, pursuant to open source code. Most current securities rules and regulations are premised on the regulation of issuers and intermediaries, such as broker-dealers, investment advisors, exchanges, and clearing agencies. The drafters of these rules and regulations likely did not contemplate that self-executing software code might displace such issuers and intermediaries. I've asked the Commission's staff to explore whether further guidance or rulemaking may be helpful for enabling registrants to transact with these software systems in compliance with applicable law. I'm also excited about the use of on-chain software systems by issuers and intermediaries to eliminate economic frictions, increase capital efficiency, enable new types of financial products, and enhance liquidity. Current securities regulations already contemplate the use of new technologies by issuers and intermediaries, but I've asked the staff to go further and to consider whether amendments to the Commission's rules and regulations would be better suited to provide needed accommodation for issuers and intermediaries to seek to administer on-chain financial systems. So while the Commission and its staff work to propose fit-for-purpose rules of the road for on-chain financial markets, I've directed the staff to consider a conditional exemptive relief framework, or let's call it an innovation exemption, that would expeditiously allow registrants and non-registrants to bring on-chain products and services to market. An innovation exemption could help fulfill President Trump's vision to make America the, quote, crypto capital of the planet, unquote, by encouraging developers, entrepreneurs, and other firms that are willing to comply with certain conditions to innovate with on-chain technologies in the United States. So with that, thank you all very much for your attention, and thanks again to the participants for what I anticipate to be a really good give and take on the panel. And Troy, keep them in line and get all the best ideas out. But thank you all very much, and have a good afternoon.
Good afternoon. As we begin the final event of this Crypto Task Force series, I think this is a good opportunity to reflect on what has come out of these roundtables and where the task force and the commission are going from here. These roundtables have highlighted that crypto is far from a monolith. We have heard a markedly diverse set of viewpoints from many different segments of the industry. We have heard, for example, from many non-SEC registered entities with varying views on whether they or their products should be required to register and be subject to SEC jurisdiction. I expect that this will be a key theme of today's DeFi panel. Back in November of 2021, I wrote an article detailing my views on the opportunities and challenges of DeFi, which I believe require industry and regulatory collaboration to develop compliant solutions. The issues I raised in that article related to market structure, transparency, and retail investor protection, among others, and still remain questions today. So I look forward to hearing the panelists' views on how we should approach these challenges. Beyond issues related to registration and jurisdictional lines, other roundtables have focused on current SEC registrants who want to continue operating under SEC oversight, but with altered regulatory requirements tailored to new types of products and technologies. In addition to these varied and sometimes competing regulatory views, we've heard different opinions on the technologies underlying digital asset products and services. We've heard panelists highlight advantages or disadvantages of particular technologies and give differing predictions on their capabilities to function effectively as part of a large, complex securities market. In sum, these roundtables have given us a lot to grapple with, to say the least. While the series was billed as a spring sprint towards crypto clarity, I am unsure whether we've identified much can be simply or quickly clarified. When it comes to crypto, it does not appear to me that the SEC is facing problems with ready or easy solutions. What we are facing is heightened expectations of rolling out major changes quickly to pave the way for crypto expansion into the capital markets. With issues this complex and stakes this high, it's better to do it right than fast. We need to grapple with the tough questions through the legally sanctioned process of formal rulemaking, as Chairman Atkins mentioned, with the full opportunity for notice and comment and public interest findings. I look forward to engaging with my fellow commissioners, the staff, and the public on what I hope will be a thoughtful and mission-driven rulemaking process for this space. Thank you to all for the roundtables you put on, all the work, and thank you all for being here today. Appreciate it.
Well, good afternoon, and thank you to the panelists and all the attendees today for the Commission's 5th roundtable organized by the Crypto Task Force entitled DeFi and the American Spirit. Reflecting on the American spirit brings to mind the expedition of Meriwether Lewis and William Clark about 220 years ago on May 14th, 1804. Lewis and Clark set out to explore the new Louisiana Territory, purchased the prior year by President Thomas Jefferson. The size of the United States had doubled overnight, but there were no reliable maps or established routes through the new land. Despite this daunting challenge, Lewis and Clark entered the wilderness to carry out their mission. While not nearly as fraught with personal danger, the Commission is similarly navigating through challenging new terrain and plunging into the regulatory wilderness under the leadership of Commissioner Peirce and the Crypto Task Force. While the Commission's tools, we don't use wagons and rope and pickaxes, but instead are things such as roundtables, public consultation, and economic analysis may be different. I am confident that our expedition can succeed in updating our rulebook to open up new opportunities for American investors and businesses. The SEC's treatment of decentralized finance and other emerging technologies over the past 4 years was not conducive to regulatory transparency and discouraged entrepreneurs and those developing DeFi from engaging with the Commission. However, That approach has recently changed under the Crypto Task Force, which is charged with coordinating the Commission's efforts to find answers to many pressing questions. Thus far, they have changed the SEC's posture on crypto, embraced difficult regulatory questions, and promoted transparency by engaging with market participants, driving innovation and change. This SEC is committed to high-quality regulation. High-quality regulation takes time, and administrative processes matter. For those who are involved in the development of DeFi, please be patient and work with the Commission and its staff towards achieving the best possible outcome. Although I am uncertain as to what the perfect regulation may look like, the path towards it begins with seeking input from the public. This journey towards regulatory clarity will likely be frustrating and may move in fits and starts. However, by learning from DeFi innovators and advocates, the Commission has a better chance at regulating securities transactions involving DeFi and protecting American investors who utilize decentralized financial services and products. Today's participants will provide knowledge and insight about DeFi's development and the existing regulatory barriers preventing growth. Such contributions will help the Commission attempt to strike the proper balance between its role as a regulator and its mandate to foster competition, efficiency, and capital formation. In DeFi, there is a landscape of new opportunities. People can transact directly with each other without relying on banks or other centralized intermediaries. The Commission should not refrain from engaging in oversight of novel areas simply because it involves thinking outside the existing framework. The legacy regulatory regime under the federal securities laws presupposes the existence and necessity of numerous intermediaries. I look forward to hearing from today's panelists as to whether such presumptions remain necessary. For example, in what types of situations do DeFi systems and smart contracts potentially eliminate the need for a financial intermediary, and how? In what situations should DeFi systems be deemed to fall outside the scope of the securities laws? What key safeguards are necessary when the securities laws apply to these arrangements? Lewis and Clark's journey lasted over 2 years and carved out an important path to facilitate westward expansion. In doing so, they provided a valuable contribution to American progress. Today's roundtable reflects the SEC's commitment to continued progress and its willingness to consider the roles of emerging technologies. As the Commission continues to move through the regulatory wilderness, it should remain true to its mission of protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation in its efforts to respond to market innovation. So thank you very much, and I look forward to the conversation.
Okay, we're almost there. We didn't bring you guys here to listen to us, but I do want to welcome everyone who's watching, and I want to thank Chairman Atkins, Commissioner Crenshaw, and Commissioner Ueda for your remarks. And of course, I'm excited to be here for our final roundtable, DeFi in the American Spirit. Thank you, Troy, for coming back and joining us. We thought you did a fantastic job the first time around, so it's great to have you back with us again. We have high expectations based on your last performance. And thank you to all the panelists for taking the time to join us today. Over the past 4 months, the task force has held roundtables on security, status, trading, tokenization, and custody. These roundtables have provided invaluable input for the Commission and the task force and the rest of the staff here. It's informed our views and has improved our efforts and will continue to do so. The task force has hit the ground running in this sprint, as you've heard, but I do think that it's more likely to lead to a marathon toward regulatory clarity. I hope that it doesn't take as long as Lewis and Clark did with their expedition. I don't want to be doing this for 2 years, but I hope that we can make some progress, and I know that all of you will help us in making that progress. So you may be asking, what business does the SEC have in talking about regulating DeFi? Absolutely none is a reasonable answer. So maybe we should just stop now and go home. But as you know, it's Washington, and so we can't do things that fast. We have to, it's not that simple. Even getting to know regulation requires some talking, and that's what we're going to do today. What is DeFi? Bitcoin is decentralized finance, but it may not be what first comes to mind when you think about that topic. If we trust Google, it says that DeFi is a blockchain-based financial system that aims to replace traditional financial institutions with peer-to-peer transactions and smart contracts. It brings to mind decentralized networks which enable people to trade tokens and derivatives, engage in lending, or participate in prediction markets. Although sometimes referred to as DeFi platforms, DeFi is not a place people go to access services that someone else provides and controls. It's software code that people use to engage in the activity of transacting without a centralized intermediary. So we're to channel one of today's panelists, I do not go to a decentralized exchange, I make a decentralized exchange. Thank you, Peter, for that. DeFi defies our traditional permissioned world of intermediaries. It enables a person to engage with her peers through a protocol that is open to everybody on the same transparent terms. No need to get consent from any centralized gatekeeper. At its core, DeFi, which blockchain technology enables, is about the freedom to transact with your peers without permission, interference, or intermediation. And that is why DeFi resonates so deeply with the American spirit. Also resonant with the American spirit is the ability of people to publish written material without permission. Code is protected speech because the First Amendment protects someone who writes a DeFi software protocol and publishes it. The SEC has no authority to demand pre-publication approval rights, even for code that could be used to exchange securities. The SEC must not infringe on First Amendment rights by regulating someone who merely publishes code on the basis that others use that code to carry out activity that the SEC has traditionally regulated. If somebody else subsequently violates the law using the software protocol, the user, not the developer of the software, should face the music. But sometimes the writer of a protocol used to exchange securities does more than merely publish it. She might also operate, administer, or maintain a platform through which the code can be accessed and that takes custody of client assets or makes execution decisions for clients. In this and other instances, the coder or her platform might be subject to regulation for that conduct. If that conduct relates to securities, the SEC might have a role to play. I think it might be helpful to think about this in context of an enforcement case that the commission brought 7 years ago, and that was its case against Zachary Coburn. That was a settled case, so we don't have the advantage of a court having wrestled with these facts, and the order is actually pretty sparse in detail. But Coburn developed the code for Ether Delta in exchange for ERC20 tokens. And under the Exchange Act, the SEC charged Coburn with causing its Ether Delta's violation of the requirement to register as a securities exchange per Section 5 of the Exchange Act. Although, again, the details are pretty sketched out pretty lightly in that settlement order. I think there are some facts that could help spur discussion on which types of activities the SEC should reach. Coburn was the only person with the ability to alter the Ether Delta smart contract, as he was the only person with access to the private key for the administrator account, which could be used to change the permissible fees for transacting using Ether Delta or the address to which of the account to which those fees were then directed. The order book sat on a centralized server that was maintained by Ether Delta rather than on the Ethereum blockchain itself. So maybe some food for conversation at the panel today. Centralized entities that use DeFi protocols that someone else wrote to serve clients don't get a regulatory pass, of course. They can use that tool as much as they can use other kinds of tools. And centralized entities can't avoid regulation simply by rolling out the decentralized label. There's such a thing as DINO, decentralized in name only. With centralized entities, of course, comes the potential for fraud, conflicts of interest, principal agent problems, information asymmetries, and other issues that are common in traditional finance. And so those are issues actually that DeFi was designed to address. But if you are dealing with centralized entities, that might be where the SEC's efforts are best spent, protecting investors, not from their own use of open source software code to engage in transactions with their peers. We also don't need to protect them from writers of code, but from providers of financial services. I hope that today's discussion will help us to ensure that SEC regulation is able to reach activities and entities properly within its ambit, regardless of what label they bear, without prohibiting the exercise of individuals' rights to publish code and interact with that code. So now I'll hand it off to Troy. I'm looking forward to the conversation. Thank you.
Thank you, Commissioner Peirce, and everybody in the task force for the chance to be back and moderate the last of the roundtable. Very much looking forward to the discussion. Before we jump into the substance, let me walk through a few of the game plan points. This is as much for the panelists as for all of you to know how this is going to proceed. So the first thing I will say is that I'll be calling on people, but so that the first three folks aren't caught off guard, they don't know who they are yet, I'll tell you who you are. It's going to be Rebecca, and then Eric, and then Michael Mosier. And then I'd ask that you keep your responses, particularly this first go around, to no more than 2 or 3 minutes, so we have time to get everybody's views on the table, and then we can really get into the discussion. When responding, your bios are on the task force webpage, and it's an incredibly impressive group of individuals. So no need to give your bio, but you could just say your name and say your affiliation and leave it at that, and folks can take a look at the webpage to get more of the particulars on your impressive backgrounds. I'd ask next that you keep it as much as you can, even if it's more than you're otherwise willing to, as much as you can, engage and interactive with one another. I would ask that you get my attention if you want to chime in. I'll keep a queue, try to keep it moving. If there are things I hear that folks are talking about similar points, I may jump around a little bit and call somebody to see if they want to weigh in. But if you just get my attention, I'll keep the queue, and we can make sure that folks have a chance to weigh in, because the more engaging it is, I think the more productive it will be for the commission. If I interrupt, I apologize in advance for being rude, but if I interrupt, it's simply to try to keep it moving so we can make sure that everybody has an opportunity. Hopefully I don't need to do that, but just fair notice on the chance that I do. One thing I think would be very, very helpful is if you're using a particular term of art, jargon, what have you, that can be useful because it can be an efficient way to move the discussion along. At the same time, not everybody has the same understanding, or people may use a word a different way or use the same word differently, what have you. So if there's a key term you're using, take the 10 seconds to find your terms. That way it can just help make sure that any points of clarification can be highlighted at the outset. We'll go for about an hour and a half until just shy of 3 p.m. Eastern time. We'll then have a break, and then after the break, there will be audience questions. I'll cover this in a minute that folks can submit. I'll fold those in to discussion, piggybacking on a number of the things that came out in this particular session, and have a good discussion after the break as well. To that point, questions are encouraged. There's a table, as I understand it, in the entrance before you came into the auditorium. I think you can find that if you want to submit a question, just write down your question. You can find somebody who's wearing a name tag that says I'm part of the crypto task force here at the SEC, give it to them. And if you're joining online today, you can submit questions through the commission's website at crypto@sec.gov, and just note roundtable question in the subject line so folks who are monitoring that know what you're reaching out on. And when all is said and done today, there will probably be some disagreement. Hopefully there'll be some agreement, but I think it will be most productive if there's a good, lively, engaging conversation. Going back to what Commissioner Peirce said in her remarks, there's a heck of a lot to think through, and I don't think we could have a better group of panelists to help the commission do so. So, with all of that out of the way, Rebecca, So if you could start us off, set the stage, if you will, maybe the biggest question of all, given the the roundtable today, and that is, how would you describe DeFi, and what are its distinctive features as compared to TradFi? And along those lines, is it too amorphous to define? Should we be okay with a more principles-based approach? Should we have something which is very nitty-gritty, technically technological in nature? And how does that inform, just as a general matter, the mindset that you think one ought to bring when trying to figure out DeFi, what it is, what its opportunities are, perhaps what some of the risks are, and what those implications then are in terms of thinking about what the appropriate regulatory framework ought to be?
Thanks so much, Troy. Thanks to the Commission for having me today and for convening this roundtable. DeFi stands for decentralized finance. I'll start at a very high level, the 30,000-foot view, and then try to get a little more into the weeds as I go in my short period of time. But none of industry regulators or policymakers, I think, have been able to come to a consensus on how to define DeFi. I typically define DeFi as a blockchain-based open software system that allows users to engage in economic transactions in a self-directed and entirely self-custodial manner without the need for traditional intermediaries. There are other people who, and a lot of regulators have defined it as simply a blockchain-based system that allows financial services. That is very broad and probably would encompass many of what even banks are trying to build today in terms of DeFi. In terms of their work with crypto assets. And some people have gotten very, very technical, as you suggested, Troy, to get into the details of, how the technology itself works, how smart contracts, which are pieces of self-executing code work, and the like. I think we also need to think about what is decentralization as we think about DeFi. Decentralization is a philosophy that generally espouses movement away from power, authority, or control being centralized with one entity or one actor, and moving towards a disintermediation or a dislocation of both actors, jurisdictions, and other dispersion of the concept of power and control. In terms of thinking about regulating DeFi today, and I'm sure we're going to get much more into the details about this, but I don't think it's actually necessary to either define decentralization or DeFi in order to determine whether a particular actor needs to be regulated. I think, as we heard in many of the opening statements, just publishing code alone is not regulatable via something like the Securities and Exchange Commission. But when we are thinking about what types of activities people are engaged in, we can understand where there may be an intersection of the law and technology, or the law and certain types of technological functions. I think algorithmic trading is a great corollary to think about it, because in theory, the algorithm that is making asset management or investment decisions could function on its own, but you have the investment advisors register even when they're using these algorithms and codes, because they can impose their judgment, they can override the algorithm when there are other types of concerns around it, and they do still, even when using code, take on certain types of control or authority activities that may require, and does require in many instances, regulation. So when you think about a decentralized exchange that is operating autonomously, much like the Uniswap code does, that doesn't seem to require, as of today, regulation of the people who built the code. But the question then becomes, well, what if you have independent third parties building Uniswap pools with tokenized securities, and who is responsible and for what in that type of activity? I think the other complicated, this is my last point, the other complicated piece with DeFi is a lot of the activities don't look like anything we are used to in traditional finance. So questions of holding keys to a multi-signature wallet that can pause a DeFi protocol in the case of emergency does not look anything necessarily like pulling the circuit breakers on the New York Stock Exchange or something like that. So I think moving away from just the definition of what we think of as DeFi or decentralization and really thinking about activities will move us forward in thinking about how we could regulate the space, if at all.
And just a real quick, and there'll be more opportunity, Rebecca, for you to pick up this point. But in addition to that distinction, as you were describing, you can say code on the one hand versus activities on the other, where does risk fit in? Is also part of the consideration, not only thinking about what are the activities, but what are the risks, and are those the kinds of risks for which a regulator should be playing a role or not? Is that part of it as well?
Great question. I think that there are three central risks that, no pun intended, that come from DeFi. One is cyber risk. I think when you really think about how these DeFi systems are built out, cyber is the most important because it is code and it is functioning autonomously, in at least for certain types of DeFi protocols. I think then there's also something called system management risk. It is there an intermediary, or is there somebody who has some form of control? Is that properly disclosed? And are they properly, I think, as we think about for Web 2 types of software platforms, protecting against certain vulnerabilities and the like. And then I think that there is potentially illicit finance risk, but the source of that comes from usage and other actors engaging in the space. And there are, I'm sure we'll get to this later, but there are ways to mitigate against that. But it doesn't look, it goes back to what I was saying before, something like holding the keys to a multi-signature wallet doesn't look the same as, the other types of traditional activities. One thing I wanted to follow up on was your question of what are the hallmarks of DeFi? I'm sure other panelists will get into that, but I think just to do it quickly, non-custodial, I think is, or self-custodial is a non-negotiable when you're thinking about DeFi. I would also say open source so that everything is transparent and openly available. I think one of the much different than how DeFi is portrayed. It is not some shadow system that's being built in the dark. I think DeFi is open, transparent, and really trying to be built in the light, and autonomous as well so that it can function without intermediaries.
Great. So I'm going to go a little bit out of my initial order because Peter's getting my attention. So I'm going to go ahead and have Peter jump in here, and then I'll come back to Eric.
Thanks, Troy. I just wanted to make a brief interjection on the question of risk and how we use it to define regulated entities. There's a very catchy phrase, same risk, same regulation, that often has a lot of wisdom to teach us. I think that, and Commissioner Peirce teed this up with a lot of discussion about First Amendment rights in this context. That's a utilitarian calculus that we see out in the world, that there are these harms that represent certain things that could be addressed through public policy initiatives, and that we could ultimately, through a consequentialist view of the world, improve the social utility of these markets, reduce investor harms. That kind of consequentialist calculation is almost always the right calculation to make, except where certain long-held American values are at stake with making that calculation. So I'd just briefly hearken to Ronald Dworkin, a personal hero of mine, who identified certain rights as trumps. That phrase unfortunately means something different now that we have a President Trump. But there's this notion that, yes, we're always going to want to try and craft our regulation or our way that we address public dilemmas with an eye towards maximizing the good. But at a certain point, even if it's the socially beneficial outcome, there are certain areas we don't tread in this country. At a certain point, a right, like my right to publish code, trumps the risk that code creates in the world. And so the risk created by perhaps a DeFi trading algorithm that allows people to engage in decentralized exchange, which is a verb, not a noun in this case, might be very similar to the risks that we see in centralized exchanges and might lead to similar bad outcomes for individuals in America. But even given that there might be some same risk, same regulation questions at play here, we would not put a prior restraint on an American's ability to publish that software. And there's more we can discuss later, I'm sure, about past case law with the SEC and the First Amendment in, say, Lowe versus SEC, but I'll certainly hold off until then.
Yeah, let's hold off on Lowe versus SEC. Maybe we'll get to the particulars there, or at least the spirit of it. But Peter, since we're with you at this moment, let me just pick up on one point, then I'm going to come back to Eric, and that is, given what you were just saying, is the principle for you that ought to be, if I'm describing it correctly, a constraint on what otherwise might be a set of considerations, almost a hierarchy of considerations in terms of how one thinks about approaching it. And people may have different hierarchies as they place different weights on all those different considerations and different value structures, et cetera, et cetera. So stipulating as to all of that, from your personal perspective, is the First Amendment the one that features most prominently?
From my personal perspective and from Coin Center, the organization where I have, that is most prominent, but it doesn't mean it's easy. I'm not a code is speech maximalist and you're never going to be able to regulate math, right? These things can become a parody of themselves and somewhat silly. And that's why, and we will get to SEC versus low later, or low versus SEC later, hopefully, but there is a lot of jurisprudence that's rich and incredibly important on the division between speech per se and professional conduct that mostly involves speech, which can be subject to prior restraint and regulation. I am a lawyer. I had to get barred in order to practice law. Most of practicing law is doing this silly thing I'm doing right now, which is speaking. Why is that prior restraint on my mostly speaking profession allowed? Because when I'm a lawyer that's barred and representing a client, I'm engaged in conduct. I'm acting on their behalf with their interests in mind. And yes, I'm mostly speaking, but you can damn well sure prior restraint my speech when I'm actually representing a client. Figuring that out in the DeFi world is very complicated, is very hard. But there is a rich, rich history of jurisprudence from our Supreme Court, which is one of the things that makes me very proud to be an American, that will help us here.
So, Eric, so taking, in some sense, what Rebecca was saying, what Peter was saying, and melding a whole host of things together, markets. So if you open up an economics textbook, right, there'll be lots of chapters on competitive markets and what makes for a competitive marketplace, et cetera, et cetera, et cetera, and all of that. Extraordinarily important, consequential, and it goes to some of the points the commissioners and the chairman were making as well in terms of what the opportunity is in terms of markets and transacting that DeFi affords. On the one hand, when you think about it in kind of less technical, textbooky sorts of ways, the words that often get used are free markets. And another word that often gets used are fair markets. And oftentimes the two come together in terms of free and fair. It is sometimes the case that in conversation, those words aren't crisply defined, that there's an assumption as to what they mean or don't mean. And there's a lot of values as well as economics that are baked into those concepts. From your perspective, as you think about markets, be they free, be they fair, and what DeFi affords from a how we think about markets perspective as compared to more centralized marketplaces, what are your thoughts?
Hi, everyone. Thanks for having me. I didn't think 12 years ago when I got my first SEC subpoena that I'd be invited to come speak in front of you all. And I want to say sincerely that I appreciate the change of tone and the change of stance in the commission. I think that's it's absolutely a positive for America. When it comes to markets, I think we have seen in crypto, in DeFi, the most American spirit rushing back in to help bring economic commerce back to where it should be. When we say words like the American spirit, I think we must recognize that that always entails a strong degree of rebellion, a strong degree of individual liberty, a strong degree of risk-taking, and a strong degree of entrepreneurialism. And starting from when Bitcoin emerged until now, with DeFi and everything that has grown up around it, it's hard not to see that as a reaction to what is supposed to be the freest country on earth, slowly decaying into one that encumbers all market participants in myriad ways. And when we see the rise of crypto, I think we must first understand it as a reaction, as a market-based reaction, because markets always find a way. And in crypto, in DeFi, we see this really coming back into force. And what would be helpful, I think, for anyone looking at this subject is to simply see the virtue and the courage in that kind of exploration. I think maybe culturally in America, we have gotten a little complacent, a little comfortable. And crypto really reminds us that there is always a frontier and that we should be pursuing it. So to see it as a noble pursuit, something that is not swept under the rug and is not like some dark machine that we can't control, but is actually, the reemergence of light back into financial systems, I think is an important starting point.
Is there a particular something from a regulatory perspective that you think would help, or at least not, that should be done to help advance what you just articulated, and or that shouldn't be done so as not to impede the advancement of what you just articulated?
Yeah, what is it in medicine, the Hippocratic Oath, right? First, do no harm, is that right? Markets do not need a regulator to enable them. They are emergent phenomena. They occur without any kind of central power making it so. And just the first recognition from regulators that that's the case would be good. And then when you look at crypto and DeFi, you have to realize that these are actually machines of perfect regulation. That the way that a smart contract operates is a perfect regulator. It does precisely what it is told to do. It executes regardless of who is using it. It doesn't matter what your background is. It doesn't matter where you're from or what your skin color is. It doesn't matter your gender or your sexual orientation. It is a true blind rule of law machine. And it would be nice if the regulators who portray themselves as caring about the rule of law would understand that these mechanisms are themselves incredible new machines of regulation, and to simply stand in awe of them at first before trying to get into all their gears and break everything that makes them so beautiful.
Michael Mosier.
I'm going to do my best.
Well, I'll pose a question, but feel free to respond to what Eric was just saying. But as a piece of that, if you think about the ways in which the financial markets in the US have developed over a very long period of time, and the regulatory infrastructure, and in part, the regulatory infrastructure has informed the ways in which the markets have developed, and the way the markets have developed has informed what policymakers think the right to write. So there's a bit of cause and effect and the arrow going both directions, and at this point we have what we have. But one of the defining characteristics of what we have is a regulatory framework across financial services, and the SEC is no exception, which is very intermediary centric. Now, I think picking up on Eric's point, intermediaries may come into existence because they can reduce what can otherwise be transaction costs broadly defined in the marketplace. So they may just come about as a business opportunity to help parties transact or whatever it happens to be, to shoulder risk or what have you. There are other instances where the government says, you, by doing this, are this, that, or the other, and we regulate this, that, and the others, broker-dealer, et cetera, et cetera. So how do you think about it where we have a regulatory environment which is very intermediary-centric, just is the case descriptively, with DeFi decentralization, which at its core, its essence is not that? How do those things should policymakers be trying to reconcile? Should policymakers, in some sense, going back to what Rebecca was saying, a flavor of what Eric was saying, and then overall big picture considerations as Peter was saying, or just say, hey, you know what, we just need a whole new construct, that we got to set aside approaches that are very intermediary centric and just fundamentally think about it differently? Is that what they should do? Or should they try to, square peg round hole? How should they approach it?
Yeah, thank you, Troy. I think Rebecca articulated a lot of the risks that we've thought through in the decentralized finance space, and I think it's not necessarily a wholesale difference. There's a lot to build on, but it is different. We're not. This isn't people shopping at a mall anymore. I mean, we've dealt with this with the invent of online commerce. It's different types of risk. So there was a time where it was people shopping in the mall. You needed a mall cop as fast as the fastest shoplifter, and you came up with cameras to watch for that sort of thing. That's not what's happening now. It's high frequency data packets that are moving at exceptional speeds. And in the same way that we move from telegraphs to switchboard operators to mobile phones, we changed the way that we dealt with risk, and the risk in the situation of a mobile phone is again, it's a communications risk. It's SIM swapping. It's not moving people back to switchboard operators because people are getting SIM swapped. And I think that's the opportunity here is to look at ways that we can automate the risk detection and make people safer rather than just injecting intermediaries. And some of this we've grappled with through many, many years. FinCEN used to regulate telegraphs as a financial institution. Actually, it's its own category. And then as there was more experience with what telegraphs were doing, it was realized, yes, they're transmitting communications data, but actually they are not a financial institution. They are a data transmitter. And they were exempted, actually, and they remain exempted from that. And there's a separate money services category specifically because data communications is not the same as financial activity, even though that some of that data might carry financial data. And part of that is recognizing that what are the risks? The risk here are cyber risks in many cases. And so we dealt with this in 2019 with the FinCEN guidance. We specifically said, there are those who are accepting and transmitting value in a sense of having total independent control over it. And then there are those who are engaged in what we call the trade, which are software developers who are developing the data communications and network services that just allow things to move. And this is also not new. Like Swift moves data messages that account for actually around $5 trillion per day in dollar transaction between banks. This is communications data that's going between banks that the banks are then updating their internal ledgers. We have RPC nodes that have gone back to the 1970s that also allow networks to communicate across each other's networks and update internal ledgers in some form. Now we have public blockchains, which are public ledgers that are getting updated in real time. Those have many sorts of communications across them, whether it's at the block building stage to the batches, all the way to cross-chain communications. All of that is getting moved across different networks to allow other ledgers to update. Now they're public ledgers. So there's a lot of cyber risk in that I think there's opportunity to be managing, but it's opportunity to manage it in a way that can keep people far, far safer than collecting personal information of people and just moving it back to switchboard operators that could then be exploited. And one last quick point on that, just actually almost crashed Perplexity AI the other day, looking up how many people have been victimized from banks losing their personal information over the last 5 years. It spun for about 20 minutes and then came up with about hundreds of millions, and that's all it could do. And I think this is one of the reasons why at FinCEN, when we were developing the 2019 guidance, we also did an initiative on privacy enhancing technology with the concept that we have to factor not just the victims of ISIS in it, but the victims of the hundreds of millions of people who are also victimized when this information isn't taken care of. And the reason to bring in privacy enhancing technology was that there are so many ways that we can do an exclusion proof that determines that someone's not on an OFAC list without sending their personal information around. And I think that's that type of zero knowledge proof that can determine what is the activity that's happening here. What is it a bot loading up? Most of these bots that are causing some of these intrusions do not have a social security number. And actually, we don't even care who they are. We're not going to extradite Lazarus Group. We see the activity and we can stop it. And that goes back to the activity-based sort of risk management that Rebecca was talking about. Peter.
Real quick.
This is a statistic we've quoted a number of times. The DOJ in 2012 found that identity theft accounts for double the amount of economic losses to individuals than all other forms of theft combined. So Perplexity AI struggles with quantifying it, and it is huge. And I would love to talk about identity more later.
Just real quick for Michael before I move on, and Jill, I'm going to come to you next with a question. But in terms of, Michael, what you were saying, do you see that risk as all of government, across financial services and beyond? Do you have a particular view as to what the SEC's role would be in that?
Yeah, I think the SEC has a tremendous opportunity to actually, when they're thinking through this cost-benefit analysis, to be factoring in both the risk of whether it's market manipulation or that someone is, well, actually a great example is someone an accredited investor. We don't need to send around everybody's information to determine that. That's a pretty basic proof. In fact, joined Espresso Systems back in the day with Jill, and one of the things that they were developing that inspired me to join them was zero knowledge proof wrappers that could verify threshold proofs of whether somebody was, say, an accredited investor, whether they were over 21 at transaction speed. And I'll just one aside on that. As a former state prosecutor and someone who worked with victims of domestic violence, I remember talking to victims of domestic violence who would go in to buy a beer at a store and go up to the checkout, and they have to show their identity. You have to show everything about yourself in order to buy a beer. And so whoever that is who happens to be at that door, at that checkout, is seeing where you live, everything about you, when all we need to know is you're over 21. And I think that's the sort of piece that we were looking at FinCEN in particular to say, there's a lot of risks here. There's ways to do this that protects people. And I think SEC is in a position, particularly with the volume that wants to come on to these public ledgers, to say, when we do that cost benefit analysis, it's going to be, here's other ways to manage this risk that takes in everybody's pain points, but also what is the tech that can be used to solve all of this? Particularly factoring in, and I'll wrap up with this, but I think factoring in that we are in a stage of hyper fast data transport now. And so we're not in a situation where a bank SAR officer can wait for the telex to come in, get printed out, look at it, send something up, determine if that person's a member of Lazarus. It's bots moving at a speed that are faster than people can detect, and that's a chance for us to leverage all the different activity-based risk detection that's much faster than a person. In fact, Chair Atkins mentioned car manufacturers. There was a study of over 200 billion miles worth of autonomous vehicles with autonomous risk detection. Over the 200 billion miles, when a car had the autonomous risk detection, the property damage went down 88% and the bodily damage went down 92%. And I think that's the place that we're in right now, is that SEC has a position to, as we bring 200 billion miles worth of trading on chain, to use this activity-based detection that's going to reduce bodily injury, but not create more victims by sending PII around. I think that's an incredible opportunity.
Jill, so has been a common theme for the afternoon so far, is the ways in which, not that there aren't complexities and lots of things to think through from a variety of different angles and vantage points, but the opportunity that decentralization, DeFi affords, not to say there aren't risks, but the opportunities as well, where you can kind of bottom line it, as again was mentioned earlier in various of the commissioners and the chairman's remarks, in terms of peer-to-peer transacting. And if you kind of broaden the lens on peer-to-peer transacting, one of the lessons from economic history outside the context of blockchain and DeFi and decentralization is we can get people who don't know each other to transact. That can create opportunity for economic growth, prosperity, inclusiveness, and a lot of good can come from that. And the question is what the institutional frameworks that allow that to happen. Here, there's a technological framework that seems to have as its promise that potential. And yet at the same time, when it comes to markets, if you got a market over there and a market over there and a market over there and a market over there, there's something that can be said for that fragmentation that you met in terms of competition. At the same time, it may be, hey, if you can get those together, there may be additional opportunities in terms of liquidity and breadth of the market, depth of the market, what have you, and how does all that happen? Does it happen organically, going back to some of Eric's comments, or does it happen as a function of regulatory requirements that tries to stitch different marketplaces together, which all leads to, from a technological perspective, questions around interoperability and how technologically can different chains and activities, et cetera, be stitched together. So with that wind up, and feel free to challenge any of the wind up, but with that in mind, what are your thoughts?
Yeah, thank you. My name is Jill Gunter. I'm co-founder of a company called Espresso Systems, and we are working on exactly that, how multiple different chains or venues for settlement can work together more seamlessly in the blockchain native environment. As I reflect on the question, and in particular, thinking about the benefits that can be brought to whether it's consumer investors, more institutional investors, with the technology that many of us on this stage have been developing over the last decade. I'm struck by all the potential that still remains, but also all that's been delivered already. I first got into this space when I was working on Wall Street. I joined Goldman Sachs on their credit trading desk shortly after 2008. Talk about a regulatory environment. As the junior person on the desk, I was tasked with understanding a lot of the Dodd-Frank regulations that were coming down the pipeline and working closely with compliance. And it was in that context that I first heard about Bitcoin and also the concept of smart contracts. And it struck me at the time how so much of what I was dealing with in my day-to-day, whether it was the rote processes of clearing and settlement that were still extremely manual, that again slid down the hill to the junior kids on the trading desk to deal with, or whether it was the processes of figuring out just how much leverage was in the system. All of this felt like it had the potential to be obviated by bringing things on chain in a way that could be transparently audited in real time, while also enabling the protections of privacy that Michael touched upon earlier. Fast forward to approximately 10 years later, and FTX, a centralized exchange in crypto, collapsed. And I will never forget sitting behind my desk, watching the various DeFi monitors that I had up, and watching liquidations happen in an extraordinarily orderly process amongst all of the DeFi protocols. DeFi stood up. And while the FTX collapse, as someone who'd built their career in this industry, felt like a catastrophic failure, watching DeFi hold up under the pressure that it was under was an extraordinary experience as someone who'd gotten into this space for that promise, again, a decade prior. And so as I think about the benefits, one of my great hopes for the SEC and the other regulatory bodies in DC is that we not just focus on the risks, and there are indeed very real risks to consumers that come with the new technology, but also the potential that it brings to transform these markets. One thing that I want to highlight based on the question that you asked, Troy, is that blockchains are no longer monoliths. 10 years ago, they were. It was Bitcoin, it was Ethereum, maybe a handful of other systems, and those systems acted in a monolithic way. If you built something on Ethereum, there was the application, and there was the underlying Ethereum blockchain. Now they function in a very modular way. And so you're not just building on Ethereum, you're building on perhaps an interoperability layer like what I'm working on. You're building on different data availability systems. You might be using different privacy protocols. And I think that it's very important in any of the guidance or rulemaking that moves forward over the coming months to bear that in mind, that in many cases, it's not the case that you can pinpoint a locus of whether control exists or does not, either at the application layer or within the blockchain. A much more complex approach is needed to understand where points of control might exist by founders or creators of these protocols, and where points of control no longer exist. And there might be many different components of the system under scrutiny that lie on different points of that spectrum. So that's a conversation that I hope that we get into.
Joe, just one quick follow-up. As a practical matter, how important is interoperability?
Oh, I think it's critical because it will exist no matter what. Markets, I believe I stand with Eric and I say that markets are emergent and they will evolve on their own, whether any of us in this room like it or not. And in our increasingly digital and global world, markets will find ways to collide. And so whether we allow them to collide and work together and interoperate safely, securely, with appropriate disclosures to consumers who might be using them in those ways, or whether we have to force them to collide in more chaotic ways or force those interactions between them underground or into spaces that don't have disclosures, it's going to happen. And so I think it's absolutely critical that we as technologists build the systems to allow that interoperability to happen safely, securely, while still meeting the standards that consumers expect. And that you all as regulators and overseers of the system create frameworks that are conducive to that.
Omid, I can see you, okay. I was looking down at the other end. So if I got this right, and I think I do, you wrote a book, a very interesting title, Re-Architecting Trust. After the colon, the curse of history and the crypto cure for money markets and platforms from a couple of years ago. So 3 related questions here, piggybacking on that. What do you mean by re-architecting? What do you mean by trust? And what is the ill that crypto cures?
So first, thank you for having me, and it's so great that these events have been taking place. For anybody who's written a book, know that you usually have the title that you want to use, and then your editor and publisher tells you that you can't use it because it's not going to lead to enough clicks on Amazon. But I did stick to my grounds on something related to architecture because I think crypto is actually a very rare opportunity to change the architecture of finance in a fundamental way, and for the better, obviously. But a lot of what other people consider financial innovation has been very iterative over the years, and the core infrastructure might be mostly digital now, but the architecture of it is actually the same as the analog era, right? Like, and we still call it a wire transfer, which goes back to the invention of the telegraph. So my interest in crypto is actually how we can achieve the goals that finance has been moving towards for centuries, but to do it in a fundamentally different way because of these new tools like cryptography and consensus mechanisms and even developments in mechanism design. So that was the impetus for the title. The problem it solves is that I think traditional finance some years ago sort of hit the limit of what it could achieve. And I think it's important not to dismiss that. There is a tendency within the crypto industry to treat quote unquote TradFi as just being bad. But we would not have the modern successful economy that we do in America if it wasn't for the very robust financial markets that we have and the banking system that we have. And that wouldn't be possible without both the institutions and the regulators that got us here. But the problems of that system are becoming increasingly apparent, especially in a global digital economy. Mainly, almost none of it runs continuously. It is designed to sometimes present the like the veneer of continuous operation, but the actual settlement is often done with significant delays. 2, the system is not transparent at all. This is one reason why TradFi needs to be heavily regulated, because otherwise it's practically impossible to know what's going on inside of it. And then 3, it is extremely fragmented. There are many databases in TradFi, and they almost never directly talk to each other, partly because a lot of the systems are national and not designed for an international economy. So to me, the re-architecture opportunity is sort of start from the first principles of, well, what do we all agree is good? We all agree that continuous operation is good. We agree that transparency is good. We agree that interoperability is good. And then with crypto in general and DeFi in particular, how do we use these new tools to achieve all of the goals that we've been working towards for a very long time?
Where does trust fit in? Just to zero in on that word. And how do you think about trust in the context of all the things you just mentioned from a more technological perspective?
So trust to me is the only product of the financial services industry. Like at the end of the day, when we talk about banking, we talk about capital markets, securities, raising money, trading things. But if you zoom out, and this is something that I'm forced to do because I have to teach a class on this, what is it that all of these institutions provide? What's the product or service? It is trust. That for lenders and borrowers and buyers and sellers and entrepreneurs and operators, there are certain guaranteed outcomes that you get from the fairly esoteric world of money and finance. And we've had one model of how we've achieved it historically, which is that we have these institutions that show up and say, we're going to do it. Then regulators come and say, well, we need you to do it well, because when you fail, it's worse than almost any other industry failing. And usually there are rules, they are handed to the intermediaries and they're asked to please follow them. And then if they don't, there are certain penalties that are entailed. With crypto, part of the re-architecture thesis, and this is the point that some of the other panelists have made, we could use code and cryptography to lead to certain guaranteed outcomes. And that's something that's never really been possible before.
Kevin, so glad you were jumping in because I was coming to you next, but let me just tee it up a bit. This may be where you're going in any event. So you too have a book, more than one, but the one I'm going to call out is The Blockchain and the New Architecture of Trust. So similar questions in terms of architecture, in terms of trust, but you also have kind of a broader purview in terms of being professor of legal studies, ethics at Wharton. And so as you think about these themes that Omid was talking about and that have featured in other commenters' comments, what's your take on trust, on architecting, and in particular, what it means in terms of how we think about the regulatory environment in terms of what's warranted to regulate, and then the how you regulate it in light of what really are fundamental differences in terms of the technology and what it allows and what it may mean and how things get done, and the less dependence on intermediaries, again, picking up on what Omid and others have said.
Sure, thank you very much. It's a pleasure to be here. I was last in this room in 2019. I said 2018 to Commissioner Peirce, but the SEC had a fintech forum. I guess they couldn't call it the digital asset or blockchain or crypto forum back then, but we were not yet talking about DeFi. We were talking about many of these same issues. And that's one thing I want to start with. They're challenging issues. I think it's important to discuss the importance of innovation and the value of not being too worried about risks, but the reality is when we get into these issues, there are risks and there are better and worse ways to address these issues, and we need to think about them, which I know we're starting to do in this discussion. Yeah, I wanted to jump in when Oden was talking about trust. I think I have a very simple definition of trust, and it's important to understand trust is not certainty. In fact, trust is something that happens in the absence of certainty. If I am absolutely 100% certain of what's going to happen, I don't need to have any trust. And this gets to, I think I take issue somewhat with what Eric was suggesting about smart contracts being perfect regulators. They are perfect to the extent that software is perfect. And we know that software is imperfect. There may be errors, there may be hacks. It may be that what we think we are telling the software to do is not what we are actually telling the software to do. It may be that when the software gets out in the world, it will interact in ways that we didn't anticipate and therefore will not produce a result that we anticipated. Same set of issues we're dealing with in the AI context with issues of alignment and so forth. So trust is about situations where we need confidence despite vulnerability. That's really all it is. It's the environment where actors are confident in moving forward and taking a risk, taking a leap of faith, despite the lack of absolute certainty. And to some extent, I think that's what regulators are trying to do. They're trying to facilitate markets. And it's true, markets will go where they want to go, but where they want to go may not be what's ultimately in everyone's best interest. United States capital markets are the best and deepest and in many ways most innovative in the world, not because they're the least regulated, but because we have a history of a very effective regulatory structure. And I think that's where we need to start with DeFi. And so on the question of trust, what I talk about in the book is that trust has architecture, trust has structures. And I won't go into all the details, but all the traditional trust structures, even though they're still valuable and useful today, have reliance on some central actor. It might be a counterparty, it might be the government as a backstop, it might be some intermediary. And those are still valuable mechanisms of trust. They produce efficiencies and other kinds of social benefits, but there are limitations. And blockchain is a new kind of trust that does not get rid of the need for trust, causes trust to be diffused in different kinds of actors and different kinds of activities, but eliminates the idea of a central locus of trust, one central point of failure or administrative control over the system. But then when we get to this regulatory question, we need to ask what's actually happening and what are our concerns? And I think one can start with looking at the text of the securities laws, but the reality is capital markets today look nothing like they did in the 1930s. They look nothing like they did probably in the 1970s or 1980s. We've had tremendous, unbelievable technological innovation and change. And so, for example, Rebecca is right that what it means to have a multi-sig contract for emergency suspension of a DeFi protocol is different than what a circuit breaker is in equities or other capital markets today. But those are both mechanisms of dealing with a real problem, which is in these complex adaptive markets, we have things like emergent harms. We have things like flash crashes happening, which is something that maybe didn't happen in the 1930s. Lots of other things happened in the 1930s. And so we need to think about what are the mechanisms consistent with both our ideals and our legal structure to address them. And so I think we need to come back and start with the concerns. And Rebecca earlier on mentioned several concerns about DeFi. My group, the Wharton Blockchain and Digital Asset Project, did a report on DeFi in 2021, actually 2 papers with the World Economic Forum. One's called DeFi Beyond the Hype. One's called DeFi Policymaker Toolkit. And in the toolkit, we go through 6 broad categories of risks and start to unpack how we might think about them. They don't all call for regulation. I'll just list them and then stop. But we should think about what do we need to do and what can we do most effectively in ways that have the minimum cost to innovation and to our values, things like freedom of speech, as Peter described, how to address them in the best possible way. We talked about financial risks. There are risks to investors in participating in these markets, various kinds of financial risks. There are technical risks, which I think is largely what's being described here under the rubric of cyber risks. But remember, these are all software systems in DeFi and blockchain. So everything at some levels is cyber risk, but there certainly are vulnerabilities and attacks and issues in the coding of the software. There are operational risks, things like key management, things like governance. There are legal risks in terms of these systems being used for illicit purposes. And there are emergent risks, things like flash crashes and flash loans and so forth, that are novel kinds of results of interacting systems. And so I think what should regulators do? They should go through and catalog the risks and then identify the appropriate ways consistent with the law to address those risks that are the most advantageous. And then to the extent that the law does not allow for that, think about how the law needs to change.
Great. So I'm going to go to Michael Jordan and then Gabe. Everybody chuckles when I say Michael Jordan here, right? But anyway, I'm going to go to Michael in a minute and then Gabe. But Eric, I don't know if there was anything you wanted to say. If not, that's okay. But if there's anything you wanted to say in light of some of the comments from Kevin.
Yeah, you're right. I shouldn't have said perfect. That's fair. I think what's important here is not that that the smart contracts are perfect regulators, but that they are a step function improvement over human regulators, frankly. A famous or a wise person once said that America was special because it is a nation of laws and not of men. This is an appeal to the rule of law, basically the idea that a society that can move to a non-arbitrary form of rule is better than one that is based on the arbitrary whims of any human. Some people are good, some people are bad, many people are bad and they think they're good. But no matter what, we're all subjective humans and we make mistakes and we're squishy in our points of view. Smart contracts are not squishy. They execute exactly according to the code. And when there is a problem, as there often is, you can patch it, you can fix it, you can upgrade it, and you can know a priori how the system will actually operate. You can never do that with men, with human regulators. This is a step function improvement. And so far from being a tool of anarchy, cryptocurrency, blockchains, DeFi should be seen as a tool of ultimate order. And that's a very different kind of perspective, I think, that is worth noting.
So before getting to Michael, Rebecca.
Just very briefly, I want to pick up on something that Omid and Kevin both said, but Omid had said trust is the only product of the financial services industry. And I think even with the heavy regulation we have on the financial services industry, both via the SEC and the CFTC and the numerous other regulators that we have in the US, which is very different than other systems around the world, I think there is very little trust in the financial services industry, and Bitcoin was born of that lack of trust in many ways. And that, to Eric's point, we need laws because humans do all have subjective judgment. We all are coming from different interactions and different backgrounds. And one of the ways to architect this trustlessness that we find in DeFi, and to pick up on what Jill said, that even in the case of unanticipated events, large volatility, DeFi code or smart contracts will continue to operate as intended as long as it was tested and the like in the right way. And so while I agree that one of the best things we can do, as Kevin said, is to look at all the different risks, I think we have to take a step back and look at the source of risk, because even if a risk is user loss, where it comes from may be very different than in the traditional securities markets, which is errors in human judgment or holding on to data. And I think most regulators around the world have said, this is a complex question. We cannot solve it in the way we're used to. And even some of the French prudential regulators have put together private French-only working groups to try to figure out this DeFi question, and have put out even sandboxes to say, well, we could do cyber assessments and green light certain types of DeFi protocols to give users the information they need to be able to have the trustlessness to engage in DeFi.
So Michael, I'm gonna just frame up what Rebecca was saying for a sec, 'cause I think it'll probably be something we come back to, and then Michael, I'll come to you with a question. So I think, Rebecca, to what you were saying, if I got it right, and just to build on, you got, and others are making similar points, right? You got the risk, what is it, what's the nature of it, what have you. But then you have the whole nother cascade of questions that then flow from that, if I'm hearing what, again, a number of folks are saying, which is, for example, among other things, you got the risk. What's the nature of it? What's the magnitude of it? How would you regulate it if you wanted to regulate it effectively? At what cost? What are the trade-offs associated with trying to regulate it, whatever it is, in a particular way or another? And then you have another question, which maybe we'll kind of park for now, come back to later if folks want to, which is, even if you find answers and say, you get to the end of that list of questions, there are other questions that you could tease out. You get to who ought to be the one regulating it, right? So that's yet a whole nother question, and that can be a function of regulatory expertise. It can also be a function of just statutory authority, which of course that can change in terms of what legislative action there may be. So the who ought to regulate, I think, is a really just important question, the authority question, the expertise question, that itself can be difficult to answer as if all the other questions were somehow easy. Those are difficult too, but then you have the who ought to regulate it, which has its challenges in terms of just trying to zero in on what the right answer is. But Michael, feel free at this point to comment on anything, because we've talked about a lot of stuff, but I was interested in something very specific, because you have a lot of experience on the investing side of things. And so when you're investing and working with those who are investing, you need to think about a whole host of things that are going to speak to whether or not this particular opportunity, this particular business, has long-term success that on a risk-adjusted basis is worth allocating capital to as compared to whatever the next best alternative happens to be. And there's a lot that goes into that. Part of that, of course, is just flat out what's the business opportunity. On the upside, part of that is what's the risk environment look like, and then part of that is what's going to be the risk management, the compliance requirements, and then to what extent does that actually hinder the ability to achieve the upside, right? So you kind of figure all that stuff out. Doing that in this particular context, where there's all the questions that the panelists have raised, the comments from the commissioners and Chairman Atkins, how do you factor that in terms of the investing, yes, don't, in this particular project, whatever it happens to be? And then relatedly, is there a particular something the SEC could do that would make at least that calculus an easier calculus? Another way to put that is to wring some of the uncertainty out of it, so at least you have a better sense as to what it is that you're investing in, both in terms of the opportunity as well as the associated risks.
a multidimensional question, but I'll start with a talk we gave at our research conference that said that tokens are broken. We think that tokens are broken for investors, for founders, for users of DeFi systems. And the reason they're broken is something that SEC can help us with, which is right now, it is more profitable to listen to user demand. We have a founder of a great protocol here. He is competed by people willing to take shortcuts. And the shortcuts are things that users want him to do because it's cheaper, faster, and simpler. We have created an environment that makes it harder for the teams to do it the right way. What we need to do is create a golden bridge that everyone crosses, that is where the best capital, the best founders, and the right set of outlines for what you're going to do if you want to access this market live. The way we can do that is reacting to the common pattern we've seen in this industry of we have a new demand for use. Someone wants to do something. Our technology is not quite ready for it. We have to make a compromise. It's too complicated to store your private keys, so you give it to someone else. That someone else doesn't do what they're supposed to do. A lot of leverage builds up and we have a crisis and we have to remedy it. In our view, the right way to do this is to give the good actors like Jill and like Stani the equivalent foot to compete with people who do not follow the same rules. And so the market does not know the difference between a lemon and a peach. And the goal of good regulation should be to help people like us price those and market those correctly.
You have a concrete example or a concrete something that illustrates?
So a concrete thing that happens, Eric talked about this a little bit, crypto systems are perfectly verifiable and auditable. We have no issues with that, and people like me get on stage and broadcast that. The problem is what happens outside the protocol. There are market maker agreements where people will pay for transaction volume that are not legible to the market. The market can't synthesize that information and price that is incentivized activity versus what looks like natural activity. Those off-chain agreements need to be disclosed if someone wants to participate in them in our market.
Does that, one last question, then I'm going to come, Gabe, to you. So just, Michael, one last question on that. You used a word that is coming up a lot in the discussions, which is activity or activity. So from what you just described, would you agree, and I don't want to speak for Rebecca, but in terms of what I believe she was saying by way of the activities-based approach, and tell me if I'm mischaracterizing in any way, that's the right way, setting aside what any particular regulation should or shouldn't be, setting aside what any particular risk warrants additional regulation, setting all those big questions to the side, just as in terms of an overall approach. Would you agree with the perspective that some have expressed, focus on activities as a way to think about it wherever that leads?
It's the only way to do it. The reason is the technologists like myself, former software engineer, will come up with a new way to provide the activity if we regulate the technology. If we regulate the agreement, someone will circumvent it. It's about the activity. What you're seeing in DeFi today, there's a market called Hyperliquid that is dominating market share. They're making changes to their software to make it more performance because users want more performance. We need to make sure users understand what they're using and why. And you cannot do that by any other way than what is the action activities being offered by the platform.
Gabe. So once again, given that we've covered a lot of territory, feel free to respond and react and build on anything that's been said. But one of the things that I thought I'd tee up here is, as I understand it, that you yourself spend a lot of time thinking about innovative legal frameworks that get at all the things that have been a focus of discussion here today. So what are some of those innovative legal frameworks, in some sense, picking up on a lot of the different points that have been made, some of which are about regulatory frameworks, some of which are about risks, some of which are about opportunities, some of which are about technology, some of which are about just kind of a different mindset and construct with which to even engage the discussion, which is not easy when we have a very established frameworks and constructs for how regulatory regimes have been built. So in some sense easier said than done. But as somebody like yourself who thinks squarely about that, how to innovate these sorts of legal and regulatory constructs. I presume it's also the case kind of organizational constructs as well, which you can think of as a form of regulation, even if it's not rules and regulations and statutes and law. Organizational structure has a way of channeling behavior, et cetera, activities and the like. So what are your thoughts?
Yeah, sure. So, yeah, I think we're starting to get into the weeds a little bit. A lot of the conversation's been very high level, but I think, you know, the devil's in the details, and I like the devil. There's a few things I would say. I mean, I absolutely agree with everything everyone has said. Yes, you have to look at, you know, there's the system, and then there's the roles of various people acting on it. But we have just had many years of lawsuits and other things around facts and circumstances-based tests, namely the Howey test. And I think that no one liked that very much. No one wants to analyze in excruciating detail the facts and circumstances of what everyone is doing on every different system in every different way every single time. So we do have to look at all these things, but the end goal of looking at those things should, in my opinion, be to divide things into categories and players into categories and have rules so that people know where they are. And of course, there are always edge cases. Yes, that's why we go to the SEC and we talk to them. We get no action letters, or we have, you know, litigations to figure out the edge cases. But we should be driving toward rules. And I believe, you know, there is a difference, as Michael was saying, you know, between a decentralized autonomous system and a system that just happens to be on a blockchain but isn't actually decentralized and autonomous. And we're gonna need in law some recognition of this, where these lines are. They may not be perfect, there may be edge cases, but we're gonna need it. Now, I do think that, you know, in terms of why are we doing this? Why does it matter? What is on which side of that line? Well, the reason is that basically, if you do this right, if you have a decentralized autonomous system, it's not that there's no trust in no one and that no people are involved, or it's this, you know, beautiful transcendental machine, but rather you don't necessarily have to trust your direct counterparty. And the things that you are trusting in generally are not individual people's discretion or that they're good people or whatever, but it's rather their incentives and their powers, right? And so what regulation should do and what legal constructs should do is help support this wonderful feature. Because if the United States and North Korea can transact on a blockchain, or if two powerful corporate competitors can transact on a blockchain, where typically they would have to use, you would have to put millions and millions of dollars into a bank escrow, and they would worry, what country is the escrow in? Does the president of that country know the president of that bank, or whatever? You don't have to do that anymore. You do it on the blockchain, and you can just trust in a broadly distributed, geographically diverse group of validators, incentives, and their very limited powers, right? So the way that law can support this is a few things. Number one, there are some things that aren't on chain, as Michael was talking about. There are market maker agreements. There may be agreements between the validators of a protocol and the labs company or foundation of a protocol where they're getting subsidized in certain ways. That is very important information to everyone to know, because that changes their powers and incentives potentially, right? So we need a notice and disclosure regime that captures these potential conflicts of interest or these potential off-chain things. Number two is many things are trust minimized by the systems themselves, right? But there are some things that are not trust minimized by it. So Rebecca mentioned the case of a multi-sig, an emergency multi-sig that can stop a protocol. And that could be very trust minimized. Like maybe the only thing you can do is you can stop the trading and you can turn it into withdrawal only mode, but there's no way that this multi-sig can withdraw the money. Well, still, nevertheless, there could be that multi-sig could just it's only supposed to be for emergencies and hacks, but maybe a government just really doesn't like the protocol and it sends everyone an order to just stop it because it doesn't like it, or because one of its enemies is transacting on it, right? And so there can be, there should be some legal arrangements still that say, okay, you're supposed to be an emergency multi-sig. Let's define emergency. Let's define what you will disclose your conflicts of interest. Let's define, is there some procedure that perhaps can happen where instead of doing something bad that people have been told to do, they just resign from it and control reverts to the DAO, right? So, I call these things cybernetic organizations, AKA Borgs, where basically you have a mix of legal protections and smart contract protections. In that example, the smart contract protection is that there's not very much they can do to the protocol. They can turn off the trading and they can turn it into withdrawal only mode. That would be a smart contract protection. And the legal protection would be the procedure whereby you define what an emergency is, when they're supposed to act, and when they're not supposed to act, right? So I do think that law has an important role here in sort of bringing out the best of this technology's capabilities to allow potential adversaries even to still commercially transact.
So Gabe, I'm going to ask a quick follow-up of you. Then we go to Peter. One, I think Peter has a thought. Number two, I'm going to give Peter the chance to talk about low for a moment. But I would encourage everybody else, since we've now gotten through and there's already been some interaction, if you want to just catch my attention, wave your hand, what have you, I can get the queue going. We'll get through what we can in the next 15 minutes or so before the break, and then we'll pick up on it as well as with the benefit of the audience and their input after the break. So feel free to get my attention if there's anything you want to talk about. Hopefully there is. I'll create the list. But Gabe, real quick, and then Peter, to you. So in terms of what you're saying, kind of the cybernetic construct that you just mentioned, for the SEC, so I'm sitting back putting my former hat on, I'm like, all right, that's really interesting stuff. So now what do I do? Right? So we just gotta get to that very bottom line question, particularly when you think about it from the perspective of the SEC's authority. And to the extent, part of the answer is, hey, these are really interesting things, but they're really for somebody else, whatever your thoughts are. But I think that would be useful to see how what you said kind of translates for agencies like the SEC or perhaps other financial regulators.
Right. It's the SEC fundamentally has a disclosure mandate. And I think that is a very, very powerful innovation. I realize people in crypto currently think it's very bad, but at its core, and there have been many things, look, there have been many things that make it perhaps not ideal because there have been layers and layers of things where it's creeped from a disclosure regime into somewhat of a conduct regulation regime, right? Like if you you force everyone to do environmental disclosures, that can end up being a conduct regulation because they don't like the things they would have to disclose as a result of that, and so they change their conduct. But at its core, and then there's things like Sarbanes-Oxley, which have so many layers of auditing and certifications and controls. These would be completely inapplicable to crypto, right? But if you just go back to the core intuition that investors and other types of operators should have all material information that they would want to have to reasonably make intelligent decisions about things. Not everything in crypto is on chain, right? And so you have to look at where the potential conflicts of interest, where are the rooms for collusion, where are the ways people could break these systems and require disclosure around those. That would be enormously useful. And I think that's really all you need. You don't need to regulate conduct that much. And the other thing would be to recognize where the information is already transparent, it's already on chain, then you don't go and require redundant disclosure because everyone can already see that, right? And so it is different, but it's a disclosure mandate and the SEC would be good at that.
Peter.
The initial thought I had is that, we're not going to want, say, an emergency on a particular specified escape hatch multi-sig contract to be something that the SEC defines, right? This would be a mess of a rulemaking that I can only imagine the kind of feedback we get from a public comment process. What you want is an emergent order here where people feel comfortable disclosing exactly how they want to set up their system and making very clear to the user how they're going to set up their system such that when they betray those expectations, you can pursue fraud claims against them. Now, an interesting question is, can we just use typical fraud jurisdiction? Do we want to use the SEC's anti-fraud jurisdiction? And are there issues with things that aren't swept into that would there still be things left on the table? And so, briefly, I put in my 2 cents. I think when you have a new emergent marketplace with new actors who are doing new and novel things, You actually want more of an organic regulatory model where people can define their own terms and then can be prosecuted for fraud for failure to live up to those terms. You don't want a prescriptive regulatory regime where people are forced to fit into buckets that have been defined ex ante by a regulator, even if that regulator is very smart. They're going to be short-sighted with respect to all the many flowers that will bloom in that world. And so, you know, briefly, to try and bodge this together with what I wanted to say about SEC versus Lowe is you have an example of First Amendment jurisprudence here where, you know, we have to figure out where the line is between conduct that we can require a license for or registration for ex ante versus conduct that you're going to be allowed to do even if it generates risks, and we will only police you after the fact. So Lowe is this disgraced investment advisor he loses his right to be an investment advisor, which is a regulated professional conduct category by the SEC. And instead, he decides to start publishing a newsletter for like 25 cents a page. And in the newsletter, you'll find all of Lowe's best stock tips. And it just so happens that Lowe gets money from the people who issue these garbage stocks and then profits off of having them in his newsletter. But the newsletter is just something that anyone can buy. And this case stretched the SEC's jurisdiction right up to the First Amendment in a way that's hopefully fairly obvious, in that the SEC said, no, you're still an investment advisor. We told you you can't do that anymore. You're supposed to register, and you're actually banned from doing this because you did it so badly before. Ultimately, when this went all the way up to the Supreme Court, and White said, actually, I'm free to, Lowe said, I'm free to publish my newsletter. It doesn't have personal advice in it to clients. I don't have clients. The Supreme Court ruled in favor of Lowe. Justice White authored the deciding opinion in a concurrence and said, look, you know, I'm not endorsing this conduct. Things that get written can be bad. But in this case, this person is engaged in the publication of speech. And figuring out what the difference is between publishing that newsletter that anyone can buy, it's not taking fees, by the way. You know, Commissioner Peirce rightly mentioned Ether Delta and the Zach Coburn enforcement action, where one of the fact patterns was that he could adjust the fee on the decentralized smart contract or decentralized exchange smart contract. It's not just taking fees, because Lowe published this newsletter for a fee and got lots of money from the shady penny stock people who wanted their stocks in the newsletter. What White said, what Justice White said in his concurrence is that there's a difference between that neutral publishing activity and regulatable conduct where one takes the affairs of their customer in hand and exercises judgment on their behalf. And so if you want a good standard for when suddenly you can be subject to some sort of regulation, I think you're right there. If you take the affairs of the customer in hand by designing an emergency escape hatch that you describe clearly, and then you betray those expectations, you're now engaged in something that looks like conduct that can be subject to regulation and not engaged in pure speech. So hopefully I mix those two things together, but.
Got it. Eric.
Yeah, I worry that this disclosure thing is a bit of one of those good intentions that paves the way to hell. I don't imagine many of you are happy going to a website and clicking on accept all every single time you visit a new website because of GDPR compliance. Does anyone believe that that has improved the human experience? No. How many of you, when you get a new credit card, read through the 15 pages of sometimes capital letters, sometimes bold, sometimes small print, to make sure that you have read all of the regulated disclosures provided by the credit card company? You don't. These things have a way of snowballing, and a much more reasonable, civil, freedom-oriented way to handle this stuff is through the notion of fraud. Basically, in your example, if a new project is doing some kind of market maker deal, well, if you're going to invest in that project, you should perhaps ask them if they're doing that kind of thing. Ask them to affirm something, ask them to deny something. It can be in a public setting, a public message board or anything like that. They will then have to answer. If they don't answer, maybe that's a red flag and you should stay away from that investment. And if they answer and then they act not in accordance with their own statements, now that is fraud. That seems like a very appropriate way to actually go after bad actors because they're actually committing fraud. There are too many different types of things that might have to be disclosed for this idea that disclosure should be a regulated forcing function. It sounds good, and it's going to lead to the experience of DeFi and crypto getting much worse. And I think now is probably the time to not tread down that road.
Why doesn't requiring Apple to do disclosures make the experience of using an iPhone worse?
Which disclosures are you talking about?
Their 10Ks, their 8Ks, their SEC disclosures that they make. It doesn't affect using an iPhone at all, and it does help the market value Apple stock, get ahead of issues, know that their financials are accurate. I don't quite get it.
I have no problem with Apple deciding to disclose things because huge investors with billions of dollars demand that kind of information.
But they're legally, but it's not really scalable for financial markets, right? Part of the reason why the capital markets, the capital equity markets work beautifully is, every individual investor doesn't go and have to talk to Apple management, right? It's just disclosed. And, it's also not, because they're required to say certain things, as you say, they must actually say something in order for it potentially to be fraudulent. Everyone has the same information. They don't have to go and actually talk to Apple about it, and everyone's in parity. I think there's a certain beauty to that. Now, it can't go too far, obviously, and there are trade-offs, right? But this is part of why markets work and why Apple can trade Apple stock can trade at great scale by many institutions, is because we've solved that social scaling problem through law. Everyone gets the same information.
Standards of disclosure can absolutely be handled by marketplaces. Like if you're an exchange and you want to be reputable and you want to draw volume to yourself, it's in your interest and it's in the interest of your customers for the assets that you list to provide certain information that you think is appropriate. And I think it's not a scary world to imagine that different exchanges might have different listing requirements. That's okay. It's okay if not everyone does the same thing. It's okay if not everyone is forced into the same regime. And that flexibility, that dynamism is precisely the thing that allows markets to grow and for innovations to happen. There's a lot of, if you go into this disclosure issue, a lot of the reason that crypto tokens are not securities is because to become a security, registered as a security, they would have to abide by these disclosures, many of which don't even apply to them. And
absolutely, you would have to tailor the disclosure regime. I would just leave you with one question, and we should probably let
then we're going to move on.
But one quick question just to think about. Why were these disclosure rules invented in the first place? Why didn't, in the roaring 20s, when it was a very free market, why didn't all these people get together and just start disclosing these things? Why did we have to pass a law about it?
We can bracket that. Maybe come back after the break if folks think that going down further the disclosure. To the extent disclosure, it's interesting because disclosure is often seen as a less burdensome regulatory technique than substantively regulating conduct or activities as such. And yet, disclosure can be difficult as well to craft a disclosure-based regime that itself is effective in terms of what's disclosed, how it's disclosed, when it's disclosed, how frequently it's disclosed, and all the rest. So it's notable, just as a general proposition, that while disclosure is sometimes seen as easier than conduct-based or substantive-based or activities-based regulation, it is by no means easy. And part of it is thinking about, from my perspective, part of it is thinking about the ways in which those to whom the information is being disclosed actually engage with the information. Does it actually improve their decision-making, or does it frustrate their decision-making in a way where disclosure may prove to be counterproductive? So it can be a complicated, crafting the right disclosure regimes in any particular context can be complicated, setting aside this particular context. So I think there's probably more to come back to on all of that. But let me go to Jill.
Thank you. As both a consumer of products in the DeFi space and the broader blockchain ecosystem, and also a founder behind some of them, I am strongly motivated by both the value and the value proposition of transparency. And for that reason, I think that disclosures, whether they're mandated from an oversight body or a regulatory body, or whether they have just become industry best practice, I think they're enormously helpful. I'm speaking even from my own personal experience as a consumer. As I mentioned earlier, these systems are extraordinarily complicated under the hood. I don't read the 15-page credit card agreement when I sign up for a new card, nor do I audit my own smart contracts as a consumer when I'm using products. But in both cases, I think the transparency and the fact that there are people in each respective industry who are scrutinizing these transparent details is extremely helpful. It's not an enviable position to be in, to either be on the industry side and trying to promote self-regulation, or to be at an oversight body to try to walk the line between being overly burdensome and creating a regime and a set of best practices that people abide by that is actually helpful to consumers. I want to touch very briefly on what I think is at stake on that front. If I was to draw a thread through my career, a common theme has been the great assets that the United States has in terms of being able to attract capital, both due to the dynamics around its capital markets and due to the power and the strength of the US dollar as a means of savings and of payments. I live in Silicon Valley, San Francisco. It is the hub of innovation globally. Every social network, every AI application that you use, that you have on your phone has been invented there. I am one of a handful of crypto founders left there. I want to emphasize that. This was not the case 5 or 6 years ago. It used to be a buzzing hub of crypto activity. It is rare these days to come by someone who is still living not just in Silicon Valley, but in the United States, who is an entrepreneur in this space. And it's due to the regimes that not only the US as a government and as an ecosystem and as a set of institutions has imposed, but it's also due to the challenging aspects that Michael Jordan touched upon earlier as an industry ourselves of the practices that have been created. There's been a chilling effect throughout the industry, especially for those domiciled in the United States, and especially on the best, most scrupulous actors in the industry. People sometimes say to me and they question, oh, you still work in crypto? I thought that it was, just sort of frauds and bad actors left there. And that's because if it feels like it's illegal to work in crypto, if it feels like you're doing something bad, it's going to drive out those most scrupulous actors, either outside of the United States or out of the industry altogether. And that's far too often been the case. And I think that it's critical that we don't create overly burdensome disclosure regimes or other regulatory regimes and further drive out the good, well-intended actors. But I also think it's critical that we have norms around transparency so that those who are trying to create best practices that do protect consumers and retail users and investors can thrive and compete against those who are less scrupulous.
All right, so we're at about time for the break, so as not to go over and make sure we have the proper break. So here's the game plan. Somebody from the commission is going to give a couple of instructions in a moment. For the queue, I have Omid and Rebecca. There are probably others, so the others can just come up to me during the break. I'll get the list going. Comments and questions that have come in from the audience, we'll fold those into the discussion, and I guess that's it for now, other than a couple of instructions.
Hello. It's my last chance at the mic during these roundtables, so thank you for indulging me. I want to thank everyone on the panel. I followed many of your work and thinking for so many years, and I appreciate that those of you who have stayed in the U.S. and continue to build. I value your contributions today. You have really defied my expectations. Innovation always feels quick because most of the time, by the time we're exposed to new technology, it has already achieved commercial success and scaled. We see the fully baked product and quickly lose appreciation for the process. A lot of the points made today about the American spirit have really resonated with me. Even my elementary age children understand the promise of freedom that America promises. They remind me on an almost daily basis that they can't wait to grow up. Because once they do, they won't have to ask permission to engage with a technology that we greatly limit in our house. That's right. They can't wait to have permissionless access to ice cream. We take for granted all the innovation that makes ice cream readily available for us. Hand churns, large-scale factories, and refrigeration. The rules and regulations around the availability of ice cream took decades to standardize. And as a result, we have a somewhat consistent and delicious ice cream experience. We will now take a short break where we, as adults, can have as many ice creams as we want. I invite you to go to the lobby and enjoy some ice cream. When we return, the panel will turn to answering questions from the audience. There are note cards available outside that you can fill out any questions that you have, or you can submit them, as Tori mentioned, at crypto@sec.gov. Ileana is here, and she can take your cards from you, or I can take them as well, and we'll get them to Troy to ask our panelists. So thank you. Please enjoy your ice cream, and see you back here at 3:30.
All right, guys, we're going to keep it here. They're going to come back at 3:30. We'll see what progresses from here. But a lot of interesting conversations, I would say, the last half hour or so. A lot of the stuff was pretty high level, and I have no idea what the hell they were talking about there with ice cream. I'm with you there, Ton. I have no idea. But I thought some interesting conversations did happen toward the latter half of, the roundtable, that portion of it. Some actual real conversation started to really come to fruition. It'll be interesting. I think a lot of people talking about some things I was thinking about, the need for, one of these protocols to basically help us make that leap from TradFi to DeFi. And I think XRP is one of those assets. I think it's going to be a group effort. I think it's going to be a joint effort. You look at what they want to do eventually is create a tokenized world. At least that's what Larry Fink wants at BlackRock. Obviously offering, ETFs is going to be a big part of it. Getting institutions onboarded by way of ETFs is going to be a big part of it. But the other part of it is who's going to help us usher in this new age of finance, this new look of finance, this whole, debate on tokenization. And I think, you look at Ripple with XRP and their stable coin, you look at Chainlink, you look at HBAR, you look at a lot of these ISO compliant coins and tokens. This is where a lot of, I think, the innovation is going to happen in terms of getting the banking industry on board and thinking about this in a different light. So guys, we will come back to the roundtable when they're back. If you guys are just joining us, they are on a break. The roundtable will reconvene here at 3:30. So I do want to ask you guys to go ahead and hit the like button right now if you're on YouTube. Share this out if you're over on X or Rumble. We've had almost 18,000 people watch this stream already on Rumble alone, which is unbelievable. I was not expecting that kind of outburst. So that is phenomenal. I'm super pumped that there's that level of interest over on Rumble. And again, anybody on YouTube, make sure you are subscribed to the channel. We've been, doing this whole crypto thing for 4+ years now. We're learning every single day. We don't have it all figured out, but we're trying to just navigate these waters. And right now the conversation has completely shifted to regulation and what this looks like. And there's big crypto implications on the line here. So I think listening into some of this, taking some notes and understanding what the SEC is talking about and what they're thinking about and how they're thinking about these issues, it's obviously going to be beneficial for us as retail investors, right? So I think it is pretty cool that they're doing these publicly. So let's take a look at the overall market here, guys. Let's take a look at the overall market. Bitcoin has been performing very well here today, and really, outside of the big drop that we had, back on the 5th, 4 days ago, we dropped down to 100K. We quickly rebounded. That was the whole Donald Trump, Elon Musk day, where we saw the market take a spin, but we have recovered fully and up over 108,000 right now, looking very, very strong. Absolutely love where we're at right now. I mean, it's amazing to me that Bitcoin's sitting here at above 108,000, and it still feels like we're very, very early, right, in this whole thing. And I know Bitcoin's different than the altcoin market. which I'm sure you're curious to kind of see. Ethereum has looked pretty good today too. It's up 2+% as well, alongside Bitcoin. XRP pretty flat here today, but they did come up nice yesterday. They're sitting right under 230. Solana's at 156. We'll take a look at some of the top gainers here. Kaya continues to look good. Bittenzer Tau as well. Fartcoin, SPX, couple of the crazy meme coins. WIF is up there. Hyperliquid still dominating the markets. ICP has awakened, so that's kind of interesting. I haven't seen ICP on the big board for a really long time, so good to see ICP make a move. So let's take a look at some of the other things that people are saying right now over on X, and we'll get some updates here over on X. Let's see here if we can go SEC Roundtable, and oops, we need a D in there. Let's see here. So yeah, a lot of people, just weighing in here, but Eric Voorhees speaks on Bitcoin and DeFi. Eric, I thought, was unbelievable. Obviously a champion of Bitcoin, a champion of crypto. The American spirit always entails a strong degree of rebellion, individual liberty, risk-taking, and entrepreneurialism. Speaking about Bitcoin and crypto. So the SEC announced it will be hosting its final roundtable. Again, this is it right here today. You guys are watching it live. They're currently on break. We're going to come back with them here in a little bit. And so don't go anywhere. Here to kind of, keep you up to speed until they get back. And we'll go over some of the news, some of the things that are, being discussed. And Paul Atkins was the first to talk today. He stated that self-custody of private property is a foundational American value that should not be lost in the digital realm. He expressed support for granting market participants greater flexibility to self-custody crypto assets. I thought that was a very important point made right at the onset, particularly where intermediaries impose unnecessary costs or limit on-chain activity such as staking. This is very interesting. I mean, he basically said, hey, without saying, there might be some areas here within this whole DeFi realm, within this whole crypto realm, where we don't necessarily need a middleman anymore, which I thought was very interesting. I mean, this is the SEC chair saying this. So that's extremely bullish. It's obvious to me with Paul Atkins at the helm. I wish he would have talked a little bit more, to be honest. I don't think he's going to talk much more. Let's take a look at their schedule here. Let's see here. So we went through all of this. DeFi and American Spirit, 1:30 to 3. Then they have their break. Then it's a town hall from 3:30 to 4:55. So I'm guessing that's just kind of like a free-spirited debate, conversation, etc. Coming up here at 3:30. But I did wish that we heard a little bit more from Paul Atkins. That would have been interesting. But again, I think the big thing that he said again stands out. That, we should not be losing this idea of self-custody in the digital realm. And, self-custody of private property is a foundational American value. And so that tells me no matter what they're going to do here, they're going to ensure that self-custody, and this is something Donald Trump, mentioned at Bitcoin Nashville back in 2024, that they would keep this intact, this whole idea of self-custody. They would make sure that we as retail investors or institutions, whoever wants to invest in the cryptocurrency market, will have the ability to self-custody their assets. And I think that's a crucial point. It cannot be lost. So let's go ahead and take a look at some of the other things around the space here in terms of some potential news events here, things that are happening outside of this going on today. Keep in mind, we do have a big week ahead of us. We've got CPI coming out on Wednesday. That should be something worth watching, and we'll be covering that. So make sure you guys are subscribed to the channel if you're not already over on YouTube. Make sure you're following me on Rumble if you're not following me there already, and following me on X. Do my very best, guys, to keep you guys up to speed and just, be a voice and help grow this whole idea of crypto, right? And blockchain. So make sure you guys are helping us out there. If you haven't hit the like button on the stream, if you haven't shared it wherever you are on Rumble, on X, definitely does mean a lot to me over there too, on all those platforms. So with that being said, let's take a look here at some of our small caps we were looking at early. I was looking at some of these earlier this morning. Yieldstone's been one I've been watching for a while. We popped up to a $33 million market cap. This is an interesting play. It's an RWA AI crypto. Been talking about this one since it's launched. It's back down to 23 mil on a little bit of a dip, but the RWA and AI sectors, I think, are going to be very interesting to watch. And if we look at the AI sector, you got BitTensor, Tau up here, ICP, Near Protocol, all of these at the top. Near Protocol was the largest market cap for a while. Now it's third largest. ICP has come back, reclaimed the number 2 spot. BitTensor is back in the number 1 spot. Renders here, FET, Artificial Superintelligence Alliance, Filecoin, which has been around for a while, Injective, one of the new kids on the block, along with Virtuals. This sector in general, and these are all the large caps, but you go down this list, man, there are quite a few interesting plays here. The whole merge of AI and blockchain is going to be very interesting because you're talking about two burgeoning industries happening at the same time within one place. And there's a lot of interesting AI solutions within blockchain, right? And some of these things that are being developed on chain can definitely help both retail investors, institutions, market makers. I think a lot of this stuff can be revolutionized utilizing AI and making blockchain even better than it already is. But that alongside RWA are the two sectors I'm probably most interested in right now outside of just Bitcoin itself. I look at Bitcoin as just a completely different asset class. You've got Bitcoin, you've got everything else. So you've got to parse out everything else. And how do you want to prioritize everything else? And I think, eventually once we get stablecoin regulation, I think the attention and focus is going to shift on overall regulation of digital assets. And I think they're going to be looking heavily at the AI sector and the RWA sector because this is where institutional money, I think, could pour in. This is where I think the institutions could make a big splash. Obviously, with Ripple and XRP and what they're doing, some huge things. If you just go over here to ChatGPT and you type in Ripple, tokenization Dubai partnership, should pop up. This was some big news that came out in the last week or so. I don't know if you guys saw this, but the tokenization of real estate to me makes a lot of sense. And Dubai Land Department has selected the XRP ledger to power a groundbreaking real estate tokenization initiative. So right now, the target is to tokenize around $16 billion worth of property by 2033. And this only represents approximately 7% of Dubai's real estate market. So think about that. Think about how early we are to this whole idea of tokenization. And people don't often put XRP in this category, right? And they should. It's not only about cross-border payments and remittances. That's a big part of what Ripple's working on and what they're doing. But you got to look at this tokenization space, just the amount of capital, right? When you're talking about what Ondo's doing, they're also partnered with Ripple, tokenizing U.S. treasuries, U.S. equities, massive amount of, potential here. You're talking about not billions, but trillions of dollars just in the RWA sector alone. Stablecoin integration with this as well. Ripple's RLUSD stablecoin has received approval from Dubai Financial Services Authority to operate within the DIFC. RLUSD will act as the transactional currency for real estate token purchases, seamless, programmable, and compliant. And why did they choose XRPL? Because it offers fast transactions with low fees, and it's able to scale, right? So good high throughput. Ripple maintains a strong local presence in the Middle East. That's the thing a lot of people don't, realize too, is Ripple continued to innovate, even though they were stunted, with the lawsuit in the United States that came down, from the previous SEC regime. they continue to grow out their business in a big way, right? In the Middle East and in Asia in particular, they've made some waves, man. They've done a lot of big things in both of those pockets of the market. So we will have the SEC Roundtable back here in about 15 minutes or so. So guys, just hanging out with you guys, you know, talking shop. Do you guys got any questions, comments? I know a lot of you guys have probably watched this throughout. It's been a long stream already, but we're going to keep it rolling. I'm curious to see kind of what happens after they come back from break. Somebody said SWE is pumping now. We didn't get fully into the RWA stuff, but outside of XRP, which obviously should be on the top of this list, it's not. You've got Chainlink and Avalanche. I like pretty much all of these, from Chainlink down to Algorand. Chainlink, Avalanche, Stellar, Hedera, Ondo, VeChain, Algorand. I've got a position in all of these, which is crazy to say, but I like all of them. I really do. I think they all could be some big players here. And I think this is where you're trying to front run where this next institutional money push, you know, is going to come from and where this capital is going to flow to. And you're not going to guess right all the time, but that's why I'm trying to pick out sectors and find the top players there, and then take some long-term, you know, or some riskier bets within those sectors too, after getting, you know, exposure to the top assets by market cap. That's kind of how I'm looking at it, right? And then trying to find some diamonds in the rough, like maybe, you know, Yieldstone within the RWA AI sector, things that are sitting here at 20, 30, 40, 50 mil, maybe even 100 mil, 200 mil. I know a lot of people have talked quite a bit about Plume. I do like Plume quite a bit. They're down here, $242 million market cap. They're one that I like. There's a lot to like down this list, right? Zebic has gotten a lot of attention recently. Reserve Rights as well. Pendle, XDC, Quant, even Injective, even the ones further down the list here, outside of the ones that I mentioned, you know, from Chainlink down to Algorand. A lot of potential here in this sector, a lot of potential. And, you know, who knows who are going to be the biggest gainers and the biggest, but I just want to have exposure to the space. And I'm not going to hit a home run on every single trade, but if I have exposure to the overall space, I'm going to have, you know, some things materialize and play out, right? That's kind of how I'm thinking about it. So with that being said, let's see here. XRP's chart, we're still sitting at 229. I'm on the hourly candles here. But if we zoom into the XRP chart a little bit and go into the 1 week, I really like this look a lot. You know, it's really good to kind of zoom out sometimes and just see how we've been channeling here and trading sideways ever since we came up to 287 back in December. Look at this. I mean, we've basically been trading in a tight window now for a while. We had, you know, a bad month here. Or a bad week rather, these are weekly candles. Bad week here to start March, but even after coming down to begin March, look how tight we've been trading here from, you know, Monday, March 10th to now. So you're talking about 3 months time trading in this very tight window. This is usually a very good sign. You know, buyers and sellers have kind of met in the middle here when we're looking at XRP on the weekly chart. Look how tight that range is. Eventually we're going to get some volatility, and I think as long as the overall market and Bitcoin continue to do what they're doing and at least, you know, stay afloat here, don't break down, I think XRP is in store for a really nice move. Right now, you know, I know we're closer to $2 than $3, but we've held that $2 support a couple of different times. You know, that's a big psychological level. Also a level of you know, support from a technical standpoint, right around like 208, 207, and $2, the psychological level. So as long as we stay above that threshold, I think we're looking pretty good. I think we're looking pretty good on XRP. And, you know, it's more of a longer term play for me than some of the other assets out there too. So if we look at a couple different things here too, let me go back to news here, see if anything pops out here. So there's some news here from CoinDesk. US SEC chair, in which we're watching here live stream today, says working on innovation exemption for DeFi platforms. So Atkins called the potential, chairman told the roundtable of DeFi experts on Monday he's directed the SEC staff to look into the changes to agency rules to, quote, provide needed accommodation for issuers and intermediaries to seek to administer on-chain financial systems. Atkins called the potential exemptive relief an innovation exemption that would let entities under the SEC jurisdiction bring on-chain products and services to market quickly. So again, this screams to me tokenization. And obviously with the Genius Act going through, it's going to be stable coins, and then I think the big shift is going to be, okay, what else are the institutions really interested in? Let's address that next, right? The big banks, the big money people. And I think this whole tokenization, RWA space, that's probably going to be a spot where we can find some really nice opportunities, okay? That's kind of what I'm looking at. Let's see here. Let's go to alts. This is kind of interesting. List of the altcoins that were searched the most during the latest Bitcoin surge. Hyperliquid's on there, BitTensor, ETH, Virtuals, SPX, SWI, Fartcoin, and Plume. Ah, interesting. That's interesting. I'm actually going to make this a tweet. This is a good tweet. Here, you know what? Here's what we'll do. Screenshot this. And eventually we'll post that up. Yeah, we're about 10 minutes away, guys, from them coming back to the roundtable. But guys, what are all your thoughts? What are your comments, questions? Let me know in the chat. I'm curious here. Let's see here. I do want to see what else you guys got cooking here. Yeah, we are still. They are still set to reconvene at 3:30 for the roundtable. I'm curious to see what else they tackle here when they come back from break. Also, guys, if you haven't hit the like button, definitely do so. It really helps us out. Almost 500 likes. We still have a bunch of people hanging out with us here. So if you haven't done that, definitely helps us out. And I'm sure as we get this thing back up and rolling, we're going to have a lot more people coming back in. Kilmar, can you say anything about Dogecoin? I mean, I'll say a few things. Yeah, for sure. I mean, Doge is proof of work. It has the retail interest. You know, it has the somewhat institutional interest too, because it's mineable. So there's a lot of big players that are in Dogecoin too. I think it has a lot of potential, Kilmar, still. I know it's nothing like we've seen, going back to 2021, but I still think there's a lot of potential for Doge. When do you expect an XRP ETF to come out? Well, I'm going to go back to something Brad Garlinghouse had talked about. Brad Garlinghouse said that, he's eyeing the back half of 2025 for ETFs. We've got a ton of them filed. They've kicked the can a little bit down the road on some of the deadlines. I think we've got a couple deadlines coming up in July. I'd be shocked if we get anything pushed in or pushed through, before August. That's kind of where I'm at right now, but things can change and shift. Obviously, we'll be covering everything for you right here on the channel. So if anything does break, we'll be all over it for you guys. So make sure you guys do subscribe to the channel if you haven't already. We will do our best to be out there, with breaking crypto news, anything that relates to XRP. Obviously, we're all over for you guys. And we'll be on top of it. So definitely stay locked in by subscribing to the channel. But I'm still looking at the back half of this year, man. I'm still looking at the back half of this year, and really the final quarter. That's kind of what I think. What price do I think XRP is going to by the end of the year? Oh man, it's so hard to tell, dude. I mean, and Ishmael, don't take this the wrong way, bro, but anybody who tells you anything like with any certainty, like they're just feeding you BS, bro. Like they have no idea. Nobody knows. It's impossible to come up with a prediction. If we stay in a broader uptrend and Bitcoin let's say goes somewhere between 130 to 150K, I think XRP could be, you know, $7 or $8. I don't think that's out of the realm of possibilities. But so much of this is going to depend on what happens with the SEC, how they regulate crypto, when ETFs go live, how much institutional interest is there, how much adoption will there be by the banks, and all, you know what I mean? There's so many question marks that's like, it's hard to, I'm just a normal guy, right? I'm just like you. Like, we're just normal folks. Like, I don't have a seat at these tables, right? We can sit inside here and listen to them talk, which I think is cool. Oh, Uncle Marv, if you just got here, anybody just joining us, we're going to be back here in about 6-7 minutes. SEC, we've been live for a while. They had an hour-and-a-half session. They're coming back here after a short break at 3:30, so we'll have it back up and running for you guys. But yeah, that's my take, Ishmael. You know, but I think here's the thing. In my opinion, you got to have your price targets. You got to have your goals in mind. And when certain assets hit your price targets, you know, you stick to your plan. If that's taking profits, whatever your profit-taking strategy is, you got to have something like that, you know, set up and in mind, you know, and you just stick to the game plan. But in terms of like giving, you know, a date or what, it's damn near impossible. You know, I could throw something out there or giving a price prediction or whatever, and we talk about it short term, you know, different support levels, resistance levels, but you know, where it could be going by the end of the year, there's so many things that, you know, could play out here. It's very hard to give you something that's like, yeah, I feel super confident about this, right? It's tough because we're just normal retail investors. That's all it is, right? We don't have a crystal ball. I wish we did. Any good news on XRP? They didn't mention XRP directly at all, but they did hint at some things. They did mention Swift a little bit and some of these older archaic systems. I thought they were going to mention XRP when they were talking about Swift. They didn't, but there were some opportunities for them to bring it up. They haven't mentioned a lot of specific cryptos. Hyperliquid came up. That one did come up. Talk about RTX. I've never heard of that one, bro. Remitix, I've never heard of that one. Uncle Marv just got in the building. What's up, Marv? Make sure you stick around, bro. They're coming back here in a few. Caesar said $1,000 by Friday. Caesar said, oh, well, listen, man, there's some crazy XRP price predictions out there depending on what you're watching. But, you know, we don't do a lot of that on this channel. We're not going to hype it up and say we're going to $300 tomorrow or whatever. But if you guys want the real insight, real analysis, real breakdowns, we do our best, you know, to scour the interwebs, give you guys good news, good alpha, good insights, live streams like this. We're doing this all the time on the channel. So, again, if you're not yet subscribed, make sure you are. I think you'll like the content. It's totally free to subscribe. It doesn't cost you anything. You're just going to see my videos pop up more. And listen, I know there's a lot of choices out there, so I do appreciate you guys just being here with me and you know, making me part of your day here. Hit that subscribe. Appreciate it, Yelton. Great content. Thanks, man. XRP to the moon. What's up? Rune Lady is in the house. Haven't seen you since like literally for years. Hopefully you're good. Rune Lady was one of the first people who watched me early on in YouTube when I was like just getting my start. I still remember that whole crew, Boca and Daniel and Rune and everybody, man. It's great to see you. Great to see you back in here. It sounded like a meeting about XRP and Ripple without saying the words. Kind of in some ways, Crud. They definitely danced around the whole XRP thing quite a bit, for sure. New subscriber here. Appreciate that, Tetris. Thanks, man. Mine is done. There are a lot of crazy XRP price predictions. Yeah. I mean, listen, XRP's been great. I will tell you guys this. This I can tell you with confidence about XRP. There's a big lack overall of just retail interest right now in XRP. The one asset, though, where there's the most interest in terms of search trend data and all of that is XRP. Like, it is head and shoulders above everything else in terms of monthly searches on YouTube and Google. So that tells me you've got, you know, the eyes and ears of retail. And those that are here, they're very interested in XRP. And I think a lot more people will be when they come back into the markets. The big question is, how much will there be in terms of institutional demand for XRP once these guidelines and guardrails are set up for crypto in the United States? That's going to be the big telltale sign. Because if you have the institutional interest match the retail interest, that's the perfect storm. Look at Bitcoin, right? At its core, Bitcoin caters to everybody. You've got BlackRock and JP. You got all these big players buying Bitcoin, but you've got people like us, just everyday folks. We're buying Bitcoin too. That's the ticket, right? Like, you need to have both. You know, you need to have both. So it sounds like they're coming back here. Here in a minute. Oop, they unmuted and then they muted again. Do you think GRT is a good long-term play? The graph is still a very interesting play within the AI sector. They've lost their luster a little bit in terms of, like, there's new kids on the block or whatever, but what they do is indexing. They act like Google does for Web 2. They're the biggest indexer on the internet. The graph does that in Web 3. So I think from a use case standpoint, Terry, there's a ton of potential. But so much of this market is driven by speculation, you know? And so we'll see, you know, when it plays out. But I like GRT. I've traded it here and there. I currently don't hold any, but trust me, I am well aware of what it is. And I'd be shocked if I didn't hold it again at some point, you know? And hopefully for the longer term, once we get, again, like, clear guidelines, guardrails, etc., and people really start to look at, you know, under the hood. GRT was one of the first AI cryptos out there, and it's still going strong. It's still a very big use case. How long has everyone been holding for? Hey, Mark, if anybody's willing to share that, they will in the comments. I was in XRP around like 48 cents. So I'm not like I'm not one of those people who got it like at a penny, but hey, during the bear market, I was accumulating, and, you know, not a lot of people were interested in crypto in general, let alone XRP. But I'm glad that, you know, glad I was accumulating, that's for sure. Any info on HBAR? Nothing too much out, you know, new on HBAR, but they've had some big news events in the last few weeks. I think they're one of those cryptos that fit into that mold of where institutional money, you know, could go. You know, when you look at what's next up in terms of ISO compliant cryptos and protocols and those that are within the RWA sector, US based, HBAR fits the bill with all of those. And that's kind of at least the way I'm thinking. Doesn't mean that's how you have to think about all this, but that's how I'm trying to kind of front run where some of this capital could flow into next. I have a large GRT bag. Nice. Where it's going, does it have a future? I think so, Ron. Yeah. $1,000. Yeah, it's not going to go to $1,000 overnight. XPX token is that's another protocol. They're in crypto payments. They're in the area of crypto payments. We've had them on the Crypto Breakfast Club before. What's going on, Ortis? How you doing? Price prediction, Zach is right. Yeah, like the $589, $10,000. It's just crazy, bro. I mean, a lot's been said, Abe, so far. I mean, it's hard to recap everything. I think the most important stuff is what Paul Atkins talked about early on about self-custody. I think that was a big deal. Let me just refresh this and make sure we're not missing anything here, because they're supposed to be back. Okay, we're not missing anything. They're supposed to be back, but I'm guessing they're coming back here in a minute. But what he said about self-custody early on, and the fact that, hey, we're working through these issues, that's important. We are coming back here, guys. Go ahead and hit the like button if you haven't already. Subscribe. If you're watching over on Rumble, thank you guys so much. Huge turnout today over on Rumble. Love it. Tons of people watching on X and YouTube too. It's definitely a big event. Markets are reacting and responding to it, and we'll see as this thing progresses if anything else comes out of this. They're basically tackling questions, Johnny, about DeFi and how to push the ball forward in the United States with DeFi. I remember Daniel's the one that called out Ergo. Yep. Oh, they unmuted again. I thought they were going to come back here. Love to see Zebek on Coinbase. Did it get listed there, or you would love to see it get listed? You guys
All right.
are trolling.
I think we are
All right, we're back.
ready to go. I heard Peter just say, I'm glad we solved it. So we're going to find out in the next hour and 20 minutes or so what exactly we solved and what the it and what the it is here. So anyway, so thanks everybody for continuing with us this afternoon. So as mentioned, we had a number of terrific questions that came in from the audience. We'll fold those in. If you don't hear your exact question posed, it's only because we're kind of weaving it into the conversation. So you may not hear it a word for word sort of way, but we're trying to make sure that we're responsive with the time that we have, realizing we don't have a ton of time, but to the great input that audience members submitted. So just with that, having been said at the outset, as I mentioned, I have a queue that's working. Encourage any and all the panelists just to raise your hand or otherwise catch my attention if you want to get in the queue, but at the same time, I won't be shy about just calling you if I think that you may have something in particular to contribute to whatever was just said or recently said. So with that, let me start with Omid.
Yeah, 2 points. First, I thought the disclosure debate was very interesting, and I'm generally pro-disclosure. But I think something to be mindful of for all potential DeFi regulations is that they impose a cost, and that those costs really matter, particularly for entrepreneurs. If you spend enough time in crypto, you start seeing everything through the lens of incentives. And like going back to the point that Gabe was making about Apple making disclosures, if I was the CEO of a large public corporation, I would want there to be very strict and very expensive disclosure requirements. Because one, it gives me an opportunity to show off what I'm good at, but two, just the cost of complying creates a moat that prevents entrepreneurs from competing with me. Because if I'm an entrepreneur, I might like disclosures because I want to show off, but with deference to my securities lawyers friends here, I might not be able to afford paying someone to help me make those disclosures. And one of the things that to me makes DeFi very special is because public blockchains are this very special kind of infrastructure that does the heavy lifting. The opportunity for entrepreneurship is vast, and that has not been true in financial services for a very long time, even with fintechs. And I'm not just talking about just the regulatory capital requirements, just like the cost of doing anything has always been high, but we already have very successful DeFi protocols where you just have one person or group of people came up with an idea, wrote some code, and now it's handling billions of dollars. So I think it's important to always be mindful that whatever regulations ultimately show up for DeFi, we don't get to the point where the next team of sort of like garage tinkerers say, oh, we have a great idea, but it's going to cost us $20,000 to comply with the disclosure requirements, because then that might mean that they might need to go raise money. And raising money, as we've seen in this industry before, often also creates other incentive problems in terms of like the kind of control that we want to get away from, concentration of ownership that we want to get away from.
Yeah, you could do thresholds like TVL, like, just have certain disclosures at 100 million TVL or whatever, there's ways to handle that.
Okay, yeah, but I think in general, just to be thoughtful of the fact that what we want is for cost to not be an impediment for future DeFi innovation. And then the other thing I wanted to say is references get made in DeFi a lot of times to the importance of preserving peer-to-peer activity, because that was the original goal of Bitcoin. But most of DeFi, this, as you know, what we understand to be DeFi within the industry, which is this ecosystem of protocols that provide services for trading and lending and so on, is not peer-to-peer. Most of it is peer-to-pool. Proof yet once again that actually historically financial services often organically tends towards intermediation because of operational and capital efficiency. DeFi is that way too. If I want to go and earn yield on a stable coin that I own, I don't want to go find somebody else on a blockchain to lend it to. I'd much rather deposit into a DeFi pool where the smart contracts then facilitate some kind of a lending function. So I think it would be interesting for all of us up here to then think about how much does the peer-to-pool model fit some of the existing rules for intermediaries, or are we going to need actually brand new rules for pools and protocols?
Can I ask just one quick question, follow up, and then we got Rebecca in the queue. So just, I want to that point about pool or protocol, and your then related point about intermediaries, activities, what have you. I guess the activities point from earlier today. Could you say a little bit more just to make folks are on the same page in terms of how you think about, or how one thinks about who, I'm going to put this in air quotes, controls, influences, runs, manages, you can think of a whole host of different words, the pool or the protocol, and how that then feeds into or might feed into a determination as to whether or not there is or is not something akin to an intermediary.
So there's a way to design a DeFi solution where nobody controls anything. You could literally just say, here are some lines of code. They have the ability to hold assets, and the code then determines what happens to those assets, whether they're traded for other assets or loaned out or whatnot. And then the code could be written in a way that nobody could ever change it, including, by the way, if something goes catastrophically wrong. Very few protocols are like that, understandably so, because a lot of these are still startups. So they want to have some time and some flexibility to upgrade, to improve, to build product market fit. And what you generally don't want a pool that anybody controls, because that's really is decentralization in name only. If whoever controls the code controls the assets, then it's becoming a lot closer to a custodial solution. So the more pressing question is usually how much the actual humans have control over the protocol. And what kind of control is there? Is it a multi-sig? Is it token-based? Is there voting involved? Is the code written in a way where whatever control could be exercised over it has to be done in a slow way over time, or can it be done tomorrow? So as much as I hate to say this, it's a cliche, but in the future, there's going to be a spectrum for all of this, because I think the market is going to want a spectrum of solutions. I think the market is going to want a spectrum of decentralization. And it's interesting to think about what role regulators could play in making sure that the spectrum exists, and then everybody sort of knows what they're getting from using different solutions.
Yeah, and I'm just going to make a quick comment going back to something I think Gabe had said before, and then Rebecca, I'm going to turn to you. And just, Omid, as you were referring to across the spectrum, one of the challenges, and I think this was something Gabe said, and Gabe, if I get this wrong, you can correct me, was about drawing the lines. Where do you draw the lines? And as simplistic as it is from a regulatory perspective, or legislative perspective, even a judicial perspective, is where do you draw those lines? Lines that determine what people can do, lines that determine what people can't do. That's no easy task, because you do that in the context of imperfect information. You never know everything about how everything could in fact play itself out. And you have your policy goals and objectives, going back to some of Peter's comments. You also have your constraints that you want to operate subject to, whatever those constraints may be. And then you say, all right, well, I'm not going to get exactly perfect given goals, objectives, how do you optimize? So am I willing to be under-inclusive in terms of achieving the goal? Over-inclusive, that over-inclusiveness, under-inclusiveness, practical challenge when you're drawing lines that figures out what's within whose jurisdiction and how is this going to be regulated or not, is just it's a practical challenge. It's not a philosophical point, it's a practical challenge. But Omid, what you were saying has particular resonance in terms of just what that means as things play out over time, and they're all different points along the spectrum, as you put it. Rebecca.
Thanks so much. So one of the things, I'll just build on a few of the things that a number of people up here have said, but I get to work with DeFi builders who started in the US and who actually stuck it out the last 4 years, who had many discussions about whether they should leave or not, but were able to build here, and they're very happy that they're here and still building in the US. So in terms of the DeFi and the American spirit question that we're answering today, I'd say at Jito Labs, they are building DeFi and infrastructure with the same principles that have driven American progress in the economic system more generally, so personal liberty, innovation, frontierism. But one of the things that I've taken away from being a lawyer in this space and working with a number of DeFi software developers very early is that you need to understand the technology before you either can give advice about where the law intersects or before you regulate it. And today, I think, is a great step forward, and there have been other agencies in the US that have been having these types of roundtables about DeFi, and I think that those are the most important things we can do right now. The European Commission actually put out a report that was authored by IBM Promontory very recently, and the last thing they said was, this part of the industry is not ready for legislation yet. The most important thing we can be doing is convening forums between regulators, policymakers, and industry to really move forward where we understand what the ecosystem is. And notwithstanding the enormous mind share that DeFi has captured to date, it is still 4% of the crypto ecosystem. And I think you can read any regulatory paper that's come out. There is a general consensus that DeFi is not tied to or otherwise integrated into the traditional financial system. So hopefully it'll not take 2 years like Lewis and Clark, but I think we do have some time to figure out exactly the right path forward. I do think that disclosure provides a really good basis to think about what needs to happen and what people should know when they are taking control of their own assets and their own economic activity. But I think the thing that we have to struggle with in the US that people don't have to struggle with elsewhere is that we don't have a single financial regulator. So you have the FCA in the UK, you have other, like BaFin in Germany, and there's one centralized financial regulator, so you could say, okay, we're going to them. But here, we are grappling with not just one, not just two, but multiple financial regulators. And so where this disclosure regime should come from, notwithstanding that you're right, Gabe, the SEC has been at the forefront in many ways on the disclosure question. I just think we haven't even addressed the predicate issue here today, which is like what part of DeFi necessarily falls within the SEC's jurisdiction. I think we could probably have a whole separate day on that. And that probably gets very, very technical, which is, you know, what type of receipt tokens, what do they look like, you know, those kinds of things. But I'm not sure that the SEC necessarily has jurisdiction in such a broad way, unless it's granted to them through other legislation to just say, you have to come up with a disclosure framework for crypto more generally. The other thing that I think is important, and I think that was mentioned during this panel, is much of our financial regulation has grown around the way that financial markets were established or as problems were identified in financial markets. So when you have these conflict of interest laws and you separate certain actors in the derivative space from each other, that came about because there were obvious problems in the derivatives markets when those rules were put together. But the industry in many ways is, I wouldn't say self-regulating yet, but there is organic work being done to mitigate a lot of the risks we talked about. So something like the Security Alliance or SEAL, which a number of people on this panel are involved in, is looking for ways to build organic frameworks to combat illicit financial or other bad activity in crypto. There are other projects in the space that are thinking of solutions to allow for more traditional assets to trade within DeFi or on-chain. Michael mentioned that Snai Kulikov was here, who is the founder of the Aave protocol, which I would say is one of the most important, if not the most important, DeFi protocol in the space. It is also highly decentralized in terms of not having control, whether it be in its DAO over the protocol or things like that. But back maybe 4 or 5 years ago, we did try to architect something called Aave Arc, which was like an institutional grade DeFi, and there were ways of finding how to get people to come into work in a DeFi system. And I have heard much of that coming back around, so everything old is new again in terms of how we are trying to put forward proposals. But in terms of DeFi, the industry is working together now. It may not all be, talked about every day, all day on crypto Twitter. That seems to be something where people are talking about other things. But I think the work is being done. And so the most important thing the SEC can do, whether it's within their jurisdiction or not, is to continue convening people, whether publicly or privately, to talk about these issues.
So I got Michael Mosier, I got Kevin, then I got Michael Jordan. But Rebecca, before I come to Michael Mosier, I want to ask you a kind of a specific question within all of that. So if you think about the SEC, one of the notable regulatory regimes and regulated entities are broker-dealers. So without getting into all the nuts and bolts, unless folks want to at some point, around broker-dealers and broker-dealer regulation and what have you, which has a variety of different components to it. Just when you think about broker-dealers and the market function they serve, in the context of DeFi, is the concept of a broker-dealer just outdated, or does it still, maybe not by the label broker-dealer, but by the kind of fundamental function that a broker-dealer serves, still have kind of currency within the context of DeFi?
I mean, that's actually a slippery slope, even if you didn't mean it to be, because I think there has been so much discussion about whether website interfaces that provide information about what is happening on chain with respect to a DeFi protocol is a broker, right? And so I think the term broker-dealer is extraordinarily loaded when it comes to DeFi, but I'd go back to what I think a number of people talked about when we started this panel, which is our SEC regulations, and actually all of our financial services regulations, are predicated or focused on persons, and the way persons is defined is through natural persons or various types of entities. I think we can also probably go down a path about whether certain types of entities in crypto that may look different or may look decentralized, whether they're actually captured in that definition. But putting that side argument aside, I think that in a true or genuine DeFi protocol, you will not have the type of intermediation that will bring the concept of broker-dealers back in. And I think, various types of front ends, website interfaces, UIs, whatever you want to call them, which are the normal websites you would go to look at, maybe you can, connect your wallet, do not perform the same functions as broker-dealers, unless there is serious off-chain activity that is not disclosed, where there may be elements of control that you're not otherwise aware of.
So A, it's about the activities, and B, it's about the details. Is that a fair summation?
I feel like that's a great lawyer answer. So yes, I think the one other thing I didn't say with respect to Gabe's, and I got a lot of, you guys seem to agree a lot when we were out getting ice cream. So I'll say to Gabe, I think the disclosure question then, comes down to who's doing it for how long, right? Because not to pick on Aave, and I mean in a positive way, it's so decentralized, is the DevCo, who may be doing some GitHub commits here and there, but is otherwise off building other things, responsible for continuing disclosure? Because then we really are regulating software developers, and I would say that's not anybody's goal.
Yeah, I agree. I mean, I think, well, look, we have a draft legislation in Congress right now that talks about, system maturity, right? And disclosure obligations potentially ceasing or being reduced at that point or changing in some way. So I do think there's a point where these systems can mature and become so decentralized and so autonomous that truly, there's no natural focal point for that disclosure. But I would still sort of say that those systems are supported by various types of secondary actors that, depending on the context, it may be interesting to get disclosure from. So, an example in the Aave context would be liquidation bots, people running liquidation bots or things like that. There was, it doesn't really apply to Aave because it's actually good and they're good actors, but, in Terra, there was the labs company. It had created the blockchain. It created various DeFi protocols on the blockchain. It ran the wallet related to the blockchain. and it ran the RPC nodes that the wallet feeds into. And there was a great expose, which unfortunately has been memory hold, it's no longer on the internet, about how these things interacted to give them a systemic advantage in liquidations on their own DeFi protocols, and they were raking in profits. So that's a massive conflict of interest, right? Because and in fact, liquidations on their DeFi protocol were particularly punitive. And they had this, they were also running these liquidation bots. So it's the kind of thing that people would want to know. So it is.
But that's a highly centralized system you're talking about. Of
No, it
course
was not
should be
highly
on-
centralized. As a blockchain, it was a completely normal blockchain.
But
It
there,
was just a
I mean,
normal
calling
Cosmos.
Terra DeFi, I think, is maybe one step too far because there was so much control. And so I think that, like, I agree with you in that instance that where you have these centralized actors who otherwise are controlling an entire.
But they weren't
ecosystem.
centralized.
They
It's
called
just-
themselves decentralized.
I know what they call. I know what they call
The point is,
themselves.
it's about how you define centralization or decentralization. I'm saying you can take a lot of elements that are decentralized in and of themselves. The blockchain was decentralized, the DeFi protocols were just smart contracts, blah, blah, blah. But if you add up a lot of vertical integration in a particular player, I don't know whether you call that centralization or you just call it vertical integration or concentration of risk. But at that point, that particular player becomes, in effect, a trusted entity, even within these otherwise independently trust minimized systems. Yes.
Yeah, I agree. But I guess the question is, like, what's the limiting principle and when, and like, what
We
the
would need to figure
legislation
that,
is.
yeah, I mean, I can't define that right now, but
Okay.
I'm confident you could draw those lines in some reasonable way. We could find a way.
We need more ice cream.
I think we're going to come back to a lot of this as the conversation goes. So Joe now in the queue, but Michael Mosier.
I think part of it just, some of this, it might be at least taken from a FinCEN perspective and OFAC actually, going back to something Omid said about it's going to be a spectrum. I mean, I think part of it is looking at things from a FinCEN perspective. It was, is it total independent control? Like, we know that there's going to be measures of centralization, decentralization. It's not so much about whether it's a centralized, decentralized, whatever it is there an element of control? What's the activity and who has control over it? And so thinking of it, and some of that is just basic commercial terms of if tort and commercial implied warranties of who has the ability to stop something bad from happening that was reasonably foreseeable. So I think some of the, like for instance, self-hosted wallets, we looked at multi-signature self-hosted wallets and said, you could be a software developer of this. And in fact, you could even be a holder of a key of a self-hosted wallet. But if you don't have total independent control, then you are not a money service business that is actually accepting and transmitting. And so I think some of these activities that we're looking through here, including the pools that Omid's talking about, there's questions of, number one, okay, who has control over this pool? And that control is what are the activities? The activities could be the ability to let somebody into the pool, or it could be the ability to pause the pool if there's a cyber incident or a code incident. And that's where also we want that spectrum that's really important, because you don't want to disincentivize people from being on a security council, for instance, that if there is a technical and operational risk that folks have described, you want them to be able to vote in that context and say, I'm pulling the emergency brake without taking on liability that you are now a broker dealer or a money service business. And we dealt with this a lot at OFAC, the sanctions arm, because there was a period where there was so much disconnect between Iranian sanctions in Europe and Iranian sanctions in the US, and American business people didn't want to be on boards of multinational companies, but we didn't want to disincentivize people from being on a board who had great judgment, and some had very technical skills like a security counsel, and we want people to be able to vote. And actually we see this daily in legal practice where people are technical experts in security and are nervous about being on a security council to actually find and make the judgment call that's really just a pause, because they're worried, if it turns out to be Lazarus in hindsight, have I committed a sanctions violation? If the SEC determines that this pool is trading securities, am I part of violating securities laws? And so I think if we look back at what are the types of activities and the types of control, then we might be able to create that spectrum that's more about, okay, you have the ability to initiate, stop, indefinitely deny, or divert value. Maybe you have the different regulatory obligation. But if it's more in an FTC, FCC, you're just part of an implied warranty, maybe that's just reasonable, foreseeable, and it's a much more limited so that people will serve on security councils.
So I'm gonna go to Kevin next in the queue, but just real quick, if I can, Michael, ask a quick follow-up very quickly. So in terms of, you zeroed in on control. From your perspective, is control as relevant as you suggest? Because with control, you can drive, influence, maybe even determine, I'm going to use a broad word, kind of outcomes. Or, and maybe it's an and, is it because with control that may give rise to conflicts of interest, kind of principal agent problems, agency costs, agency problems, which are often in kind of broad terms what regulatory regimes are focused on? Is it because with control you have, by extension of that, control over information, you know things, so if it's a disclosure point, you have the practical ability? Is it other things? What's the salience in 20 seconds of control? On the one hand, it seems intuitive, I think, in many instances, but control is not a self-defining concept, nor is how do you measure it, and nor is why do you care about it?
I think actually I would go right in reverse order there. I think we have to look back at why do we care about it. So I think a Cisco router controls the communications networks that might be talking and moving trillions of dollars worth of data throughout the world, but we don't consider them an ATM, and we don't subject them to the same regulatory situation that we would a regulated entity that can control how value is transmitted, even if it going down causes an issue. AWS going down causes all sorts of problems in the financial economy writ large, but we don't consider them a financial institution. And so I think it's looking back, okay, why do we care? We care not because there's a broad general impact and there's probably a critical infrastructure issue around cloud services, but they're not able to individually target a transaction and divert it or initiate it in a way that goes back to consumer protection on some level. Like, would this person reasonably have a tort or an implied warranty that they should have be able to take action from? And then I think from a regulatory perspective, is this something where that person, we don't really think they're going to reasonably be able to take that action, and we need to make sure that there's some sort of parameters to protect them around it.
Kevin.
Yeah, that's a great jumping off point. I think the issue of control is central. It's not just central in DeFi. It's also the question why should we not be so concerned that a terrorist organization might be operating a Bitcoin node and mining because they don't have control over the transactions that are going on top of the network. This relates back to something I wanted to point out that Rebecca said early on, and then we just, I think, glossed over, and I don't think we should, which is the issue of custody. And what she said was non-custodial is, I believe, a non-negotiable element for something being DeFi. I would tend to agree, and I think that's something that is simple and straightforward that the SEC could help in terms of defining out. There's a lot of things we need to talk about in terms of how to draw these lines. I pointed out in part because I don't think there's necessarily broad awareness of that. Maybe there's just agreement on this group. I don't think necessarily, but I'm co-chair of what's called the Global Futures Council on DeFi for the World Economic Forum. And this element of non-custodial is a piece of the definition that the earlier report had included in DeFi. And we had a discussion about it a couple weeks ago, and this was the most controversial topic, that there were a lot of participants in this group, which is a diverse international group of experts in relevant areas, were pushing back on whether something can be custodial and still DeFi. And Mike, I think, gave a great example that a lot of the harms that we are concerned about and that regulation exists to address come about when there are actors who have custody and have that control. There's other kinds of harms, it's not all the harms. So I think that's a straightforward one. And that leads to the second thing I wanted to say briefly, which is something we haven't talked about at all yet, which is stablecoins. Stablecoins, I would say, are not DeFi, but stablecoins are essential to DeFi because you need money on chain, and therefore you can't directly use fiat. And stablecoins have both enabled DeFi and been enabled by DeFi, but the largest stablecoins by far are custodial. And in all likelihood, if the legislation passes in the U.S., the only legal stablecoins in the U.S. will be custodial. And so I think that raises some questions that's partly, potentially a challenge to the DeFi model. It's partly an opportunity that some of the issues we may be concerned about, like illicit finance or some of the issues in terms of being able to stop transactions, maybe could happen at the stablecoin level as opposed to in the DeFi protocols. But there are also stablecoins that are non-custodial, not even algorithmic, but either over-collateralized stablecoins or strategy-based stablecoins like Athena. So I think this is something that needs to be in the conversation. Last thing I'll say really quickly is I think there's also an opportunity and a value in regulators doing some scenario planning about where might this go. We've heard a lot here about the value of DeFi, and Jill gave a very great example about the success of DeFi in the environment after the collapse of FTX. There's reason to believe that this is a better way to do digital asset trading, and that if it gets regulatory clarity, that it could dominate the marketplace. And I think it's worth thinking about what that means in terms of operation of securities laws. It's also possible if tokenization of equities and other securities can happen on digital asset platforms, that DeFi could come to dominate all capital markets. And therefore, we should think about what that means. And that doesn't mean regulate it as traditional securities trading ahead of that happening, but it means not sticking our heads in the sand and not sketching out what that could look like and what might be responsive to that. And I think now's the time to start asking those questions and doing those scenario plans.
So Kevin, so just to pick up on that, and then I'll get to Michael J, and then Jill and Peter. But Kevin, just to pick up on that piece, can you say a little bit about, two opposing scenarios as you see, realizing that it depends upon a whole host of things and how they play themselves out, but just the kinds of things that you contemplate as, hey, if that happened, that may be in the good bucket. If this other thing happened, that may be in the not so good bucket.
Well, let's, one scenario is at some point in time, the dominant share of maybe all securities, but major asset classes will happen on DeFi platforms. And one way to interpret that is great. We now have a technological solution to many of the problems that cause the need for regulation. One way of looking at that is we've now basically eliminated all of securities regulation without thinking we were doing so, thinking we were not imposing rules where they don't necessarily apply, and yet the problem still exists. So I think it's an interesting and important empirical question. How many of the problems can be addressed and what can we look to as these markets grow? And it goes back to what I said before. Again, that starts with identifying what are we worried about? Are we worried about financial crime? Are we worried about investor protection? Are we worried about other sorts of things, systemic risks of system failure through interacting agents? And the reason I ask those questions is not because we want to say, oh, there's a risk, so therefore we should stop it. But because we want to back out, there's a risk. How big is the risk? What can be done about the risk? How do the rules address the risk? What are the pros and cons? What are the harms that those rules cause? So again, it's just going through that exercise, but not doing it based on the way the world looks today. It's starting from certain endpoints about how the world may look tomorrow.
Michael Jordan.
Awesome. Our goal for being here today as investors is to improve our market that we invest in. And one thing that we struggle with that we'd love feedback on is how to do forward statements in this context. A lot of what we do is invest in early stage technology companies. They make representations to us and to the market about what they're going to deliver. It's very hard to hold them accountable for that in this context. It's hard to underwrite an asset when you can't predict its future. And when you have a live token of an instant price, how do you then hold the people who issued it accountable for delivering the forward statements they're making? It's a very complicated thing. This is not actually an easy problem to solve. And it's only going to get worse. If what you're seeing from the other asset managers in the world of bringing private illiquid securities to retail investors, the amount of information asymmetry in private markets, technical complexity and nuance required to underwrite the security is going to create a massive issue for people trying to underwrite what's happening today, what statements have been provided, and how do we hold people accountable to those statements.
Gabe, it looks like you were looking at.
Sure. I mean, this isn't an unusual, like a new problem in securities law. Just to be clear, there's been a long. If you look at every SEC disclosure statement, there's something called a forward-looking statements disclaimer at the bottom, right? And so there's rules around that. But what I would say is, you're allowed to disclaim certain forward-looking statements in securities disclosures, and you're supposed to say, hey, these are forward-looking statements, but it may not work out, and blah, blah, blah. And generally, people are not liable for that under the securities laws. It's actually a corporate governance problem. So you as an investor, right, when you invest in something, instead of just doing a SAFT and these lightweight things that have virtually no rights for you, you should be investing in proper corporate governance structures at the early stage, pre-TGE, pre-network, whatever. And at the later stage, you should be insisting upon things like boards, things like foundations that don't just say, hey, no one knows anyone if you do fiduciary duties or disclosures, and you can do whatever you want, basically, as long as it somehow relates to a certain token. And instead, have those be more exact and give yourselves information rights and other rights over these organizations in the long term. So personally, I think this is not a problem to be solved by the securities laws or by the government. It's to be solved by really good investors who have leverage over projects, contracting with those projects for good rights. And for some reason, I don't understand it, because I'm a corporate governance guy. Originally, I was in M&A. Crypto investors don't do this. They're very, very reluctant to actually have governance rights over the things they invest in. But you can solve this as an investor.
Well, first of all, I think that most crypto investors, you can keep me honest if not.
Every single time.
Well, but I would say they don't want to be, never wanted to be part of these corporate governance structures because the risk was so great in the United States. So, right, like even projects that I was representing would beg for their lead investor to be on the board, and they would say, no, I don't want to do it because I don't want to get a subpoena. They got subpoenas anyway. So that's one. But I do tend to agree with Gabe that this is a contracting problem on the forward-looking statements in terms of what people may say to you in their pitch, and then what you actually get in terms of contractual rights. Because you're talking about it, and I'm like, well, if you relied on that, then you have a contract claim. But to Gabe's point, if you don't have that within your, contractual rights, you may not be able to do anything about it.
Yeah, to try to get to the market fairness point, investors that have not spoken to the team do not have a lot of this information, to be fair. There is significant market asymmetries that cause price distortions. That's what we're trying to resolve. Every term sheet I've ever given has had these type of control requirements in them, and we have them in many. But this thing becomes a live, dynamic, decentralized network if designed correctly. And there are things that happen that are not public, on-chain, and high resolution to the market for it to price incorrectly. It needs the ability to communicate about the present and future representations in a safe and transparent way to not disadvantage retail investors so that venture capitalists and other people with more information have edge.
So I'm going to come to Jill next, but Michael, just to stick with you for one quick follow-up. So to get very specific on that and that point, is the suggestion from your perspective that, assuming the SEC has jurisdiction, right, that's a whole separate question, right? Whether or not somebody's security exchange, whatever. But let's just assume they do for purposes of this question. Is your suggestion that in a very specific, focused way, the SEC mandate certain disclosures under the federal securities laws that are fit for purpose for what you're describing?
This is not meant to be a suggestion. It's meant to be highlighting a very complicated market distortion that we are thinking through as risk underwriters today. And we'd like to improve the quality of the market by having these forward guidance disclosed in a sane and fair, equitable way.
Got it. And then just to circle back to Gabe real quick, and then I'll come to Jill. I guess the question for you is there a particular something that you think from a disclosure perspective would be, above all else, again, assuming jurisdiction on the SEC's part, this is something that you think should be required to be disclosed in the context of certain, DeFi?
Yeah, I mean, it's material agreements among material players. I mean, that's about the most succinct way I could play it. Market makers who are have a systemic role in the industry, they should be disclosing their agreements with particular projects, all these things. I mean, I agree, it's partly an investor quality control thing. It partly could be helped with disclosure, but it can't just be, to Rebecca's point, it can't just be only on developers, because there's all these secondary players that are relevant, and the exchanges and all these things. And if you get good disclosure, sunlight is the best disinfectant, and the whole market would be better informed.
Got it. I mean, there are interesting questions. Maybe we'll come back to this as we play through, which is on anything along those lines, what is the SEC's jurisdictional hook, right? Because a lot of the discussion is about, technology, if you will, code.
All of these systems are going to have securities in them. I would argue almost all of them already do have securities in them. They're all going to have securities in them, right? So, I mean, ideally, it would be something that Congress passes, right? And I think this will happen sooner or later, right? Or it could be some cooperation between the SEC and the CFTC. But in reality, I mean, I think vast majority of these systems, sooner or later, if not already, are going to have securities in them for whatever it's worth.
I imagine folks may want to chime in on that. So anyway, if you do, catch my attention. But Jill, I wanted to go to you.
Thank you. Yeah, I'll stay on topic here because I think this is a great conversation about accountability, disclosures, and risk mitigation. And I just want to draw attention to the fact that the industry has not waited for regulators and overseeing bodies to chime in on this. This is something I'm really proud of as a participant in the industry, is that industry has done an excellent job, I would say, of self-regulating and self-policing, in particular over the last 5 years. And I'll give a quick example of one of each of those on accountability, disclosure, and risk, respectively. On accountability, we see projects get taken over by their communities. It doesn't happen often, but it does happen where we have on-chain governance systems. Token holders have a vote in the direction of the project, in particular in the way that funds get spent by a project. This is all transparent, enforceable on-chain, and we see communities, from the perspective probably of the founders of these projects, go rogue on them, where they say the founders aren't delivering what they said they would deliver. Those forward-looking statements were indeed bogus, and we're going to take the project in a different direction. This cuts both ways, but I think that it, taken the right way, is a positive development in terms of self-regulation by the industry. An example on the disclosure front is a website and a team called L2Beat. So in the Ethereum ecosystem today, you have all of these different chains. It's no longer a monolith, as we talked about earlier. You have all of these layer 2 chains. And so L2Beat, i.e. layer 2 beat, I encourage everyone who has their phone or laptop out, go to l2beat.com. It's an incredible dashboard and repository in which an independent team has created their own framework that has made it incredibly legible, even for new users, to come in and understand the risks associated with and the levels of decentralization associated with any of these apps or chains. And I think that that is a great example of self-regulation, self-policing by the industry. And if you're going to wade in and create disclosure rules, you have to talk to the people behind that project, and you have to look at that website before you get started. Yes, there's one for DeFi as well. That's a great point, Gabe, DeFi Beat. The third example I'll give of self-regulation, self-policing just happened last week. So we've talked a lot about the risks of decentralization on this roundtable this afternoon. One of those risks is that there's no recourse. If something is truly decentralized, if you send money to the wrong address, there's no chargeback. You're not getting it back. There was an instance last week that went somewhat viral on crypto Twitter. Someone had used a piece of software built by a great company called Gnosis, not realizing that they were using a legacy version of it, sent their entire net worth to the wrong address that they thought was associated with themselves, but in fact was not. They thought that a black hat hacker had been squatting on that address, just waiting for them to do it. And within a matter of hours, it became apparent that, in fact, it was not black hats. It was a white hat group called Protofire that had been squatting on that address, foreseeing that this could be a possibility for folks in that situation using the legacy bit of software. This was all disclosed, by the way, ahead of time by Gnosis, but to Eric's point earlier, we don't all read the fine print, but the white hats got the entire net worth of this individual back to him within a few hours. So I just want to highlight, a lot of bad horror stories get told about the way the crypto industry acts and behaves and runs amok in the absence of guidance. But there's a lot of good to be found as well.
So just to pick up on that, and then Peter, I'll come to you. So Jill, in terms of the self-policing and self-governance that you just spoke about and gave examples of, and realizing you're not, I don't believe, looking to overextend the point or go farther than you intend to go. Nonetheless, here's the question. In light of that, and I'm sure other examples like that you could share with us, what's the SEC's role? What do you think of in terms of that balance between self-policing, self-governance versus when the government needs to come in, whether it's the SEC or otherwise, and as to which risks, and I know we could go in a lot of directions and that could get very technical very quickly, regulatorily wise or technology wise, but how to figure out and how to think about that balance.
Yeah. So I'm not a lawyer up here, so you won't hear my thoughts on Lowe versus SEC today, sadly. But I do think from a layman's perspective, I tend to associate the SEC with consumer protection. That's how I think of the SEC's mandate. And that's something that I've been very grateful for at times. And then there have been other times where I have felt like, candidly, the actions of the SEC have been misguided and long-term, in terms of the second order effects, caused more harm than good to consumers, not to me as an entrepreneur, but to consumers of the crypto space and of the industry. And I think that this is where, again, I want to highlight areas in which the industry has made headway on its own in terms of consumer protection. I'm less going to sit here and say the SEC should come in here, should come in there, but I think that there's a lot of lessons actually the SEC can learn from the crypto industry in how best to protect consumers of it.
But the crypto industry could do a lot better too. So I love those examples that you give, but I think too often they are the exception, not the rule. And I bet every single one of us here finds ourselves in situations regularly where we see the crypto industry do something where we just shake our head. And I think the best way to avoid there being the kind of regulations that do disrupt innovation and progress is for the industry to just clean up its act a bit more. Unfortunately, the incentives aren't. Usually the incentives are actually the other way around. I think, Michael, this is what you run into all the time, that there are people making money from doing these shady deals behind the scenes, but we as an industry could do a better job of policing our own.
Peter.
So I'm going to start by diving back to something that we abandoned a little while ago, but I'll bring it back to this current conversation. Not Lowe versus SEC, more First Amendment. No, Mike Mosier brought up the control question. And I'm happy to highlight this today because yesterday in a new version of the Clarity Act in the House, we got an introduction of language from Rep. Torres and Rep. Emmer's original Blockchain Regulatory Certainty Act, which is a piece of legislation that's intended to clear up the question of whether you're a money transmitter and therefore subject to unlicensed money transmission liability, as are the developers of the Tornado Cash Protocol and the Samurai Wallet, which have both been prosecuted in the Southern District of New York. That law is very important because, well, FinCEN in 2019, Mike knows quite well, said you're not a money transmitter if you don't have control, total independent control over customer funds. And it's important to create that bright line rule in that context because of the gravity of the penalties that someone will face for breaking that rule, and because of the low burden of proof for culpability that a prosecutor faces when they bring that action. Because this is not a money laundering prosecution. This is not you knew that you were helping this person evade the law or hide their money. This is you were doing something that we define a certain way and you never registered with us. And that's basically a strict liability criminal felony then. You just need, the only thing the jury gets to decide is whether you registered or not, which is quite simple. And so the legal question of who is on the hook to register or not is the whole game, and therefore you need a crisp standard so people know what side of the strict felony liability they're on. And that's why in, say,
anti-money laundering, Bank Secrecy Act contexts, where registration or licensing is required, that's the standard I want. That does not mean that that's the full and total and end and be all of where we have regulatory obligations or not. That's already not the case. Someone who doesn't have control and is primarily engaged in the publication of software could be prosecuted by the FTC or the CFPB for unfair, deceptive acts and abusive acts for the CFPB practices when the software that they've published harms other people and they were, manifestly negligent in the way that they published or described that software. That also doesn't violate our First Amendment principles inherently because it's not a prior restraint on speech. It's penalties for doing harm with speech after you've published. It's not a Bureau of Censorship, it's a reasonable liability regime as we have for things like defamation. And so I think what we're getting at, one of the things we're getting at here is that there are a lot of other categories beyond I have control or not, where someone has made assurances to their users in technical documents or maybe in user interfaces or more intelligible for the ordinary person areas where the users have come to rely on those assurances. Maybe it's an implied warranty, maybe it's some sort of cause of action and negligence, and we want there to be some guardrails in place there. Now, the interesting question is, what is the role of the SEC there? Because a lot of that could be done using existing fraud or even just basic negligence torts. And that might be the right way to do it, because when you have that freedom to sort of have plaintiffs' attorneys construct their theory of liability, I mean, let's just go back to 1L law school, duty, breach, cause, damages. Make a case that they had all of those. They had a duty because of the way they present themselves to consumers. Everyone assumes that they're going to act in a certain way. They breached that duty. The escape hatch was supposed to be triggered when condition Y materialized, and it didn't materialize. They caused it. That was actually the reason that someone lost funds. And there's damages that are quantifiable, so they're not just speculative, where you could just basically use this as a sledgehammer to kill all innovation by always claiming that eggshell skull rules aside. That's a flexible system, and I like that. Now, why aren't we there with DeFi now? There are actually some really hard topics that maybe we don't even want to air on this panel right now. For one, even developers of fairly centralized projects that are not custodial will disclaim that they are any kind of incorporated organization. And they'll say, well, it's a DAO. You can't sue the group. We can't be jointly and severally liable because we're a DAO. We're not individuals working together to profit off of the common management of a thing. So that's a really thorny question. We need to look at the Uki DAO private action, the CFTC suit, for ways that we can find a way through that really thorny question. I'm from a civil liberties organization, so you might say, like, Peter, why are you talking about DAOs being jointly and severally liable? Well, the fact of the matter is, I'm less afraid of that kind of liability than failure to register liability. Because there will be a showing in court, there will have to be proofs of duty, breach, depending on the cause of action. And this is how we actually grope towards an idea of what kind of standards do we want to have in place in the space. And it's done in retrospect rather than some legislature thinking like, oh, I can figure out exactly how all these things should be built ex ante. Why we're not there, I think, is partially incumbent on us, but it's also because there's been this terror of using existing private law to form your organization. Because God forbid you actually incorporate or even have a document that says you're all interested in working together on a thing, because then you'll get slapped with failure to license as a money transmitter and you get arrested at 5 a.m. and prosecuted for a strict liability federal felony. Similarly with the SEC's highly aggressive approach towards token issuance in the former chairmanship, I think there were a lot of people who thought, like, I don't want to look anything like a possible fiduciary to my co-developers because I'm mostly worried about unregistered securities issuance, a sort of a failure to check in, rather than the liability for disappointing my co-founders because I should have been treated as a fiduciary in some regards to them and I wasn't.
There's also, I mean, just quickly on the tort thing, there's also the economic loss doctrine, and so.
It's a favorite of mine, yeah.
The cases that have been brought, like the MakerDAO Black Thursday thing, I'm pretty sure that was dismissed out of hand on that basis. So it's tough. It's tough.
Well, and an interesting question as to the SEC's role here is, are there areas where the SEC can help us define what negligence per se is? And is there any jurisdiction under the SEC for those things that are relevant to securities transactions to obviate the economic loss doctrine, to say, actually, in this case, you don't need to prove physical harm to the plaintiff, you can just cite economic damages? These are approaches that I would be very interested in having conversations about, because we actually would start working towards more nuanced bottom-up legal solutions as the common law can typically deliver, rather than trying to reason in a vacuum about who's going to have to come in and register and not.
Michael J.
Yeah, Rebecca was earlier talking about a project called Aave Arc. Galaxy, my former employee, was one of the first design partners. And the reason it didn't get off the ground the way we hoped was everyone had to check if it was okay with compliance. And by compliance, I mean everyone at the bank or whatever asset issuer it was. And the point of this story is that the SEC can help us get real people with real risk teams involved by making sure people are understanding what's happening, what's appropriate and what's not. It was 100x more work to get Aave Arc off the ground than the other projects we were doing, even though we were doing 10x better risk mitigation than anyone else in the industry was. And so we were being penalized for trying to work with real people in a very safe way. And so when we're thinking about practical things we could take away from this, it's not that all action or inaction is a help. It is making sure that the stance of people is, hey, we want to work. We want the real participants to come in with real risk departments and help you grow.
Just to key off of Michael's point, just to go back to Aave Arc, because everything old is new again. I think one place actually the SEC could put out really helpful rules, because I don't think the only reason it didn't get off the ground was for checking with compliance. For sure, that was part of it. But the permissioning of the system, there was a collective action problem on the permissioning for entrance into the system. And so to Gabe's point, if we are going to have, or if we already have securities trading on DeFi protocols, I'd say, at least, I wouldn't say broadly, but in certain instances, we know that there are securities, at least in permissioned pools on certain DeFi protocols. What the SEC can do is should talk about the permissioning or the whitelisting standards of the people who are going to let people into those systems, right? So when we were thinking about Aave Arc, it was like, well, are your standards of KYC or whitelisting the same as ours? And can we let that other person in and things like that? And so I think that would solve the collective action problem of what do you need to do to allow someone into a permissionless system where securities are or might be traded.
So I'm going to go to Peter, and then Eric, I want to come to you.
And ideally, we can do a lot better than the existing permissioning done by the financial institutions. Because right now, when you want to open an account, you have to submit your passport photo, your mother's maiden name, all kinds of absurd private information. And yet, you know, scammers and bots still get through those filters while innocent Americans are just struggling to open an account. So we have a lot of great tools in our space. There's a verifiable credential standard that's actually predates cryptocurrency, just for passportable digital identity. Now, you can do a lot better than just, I can prove that I have a digital signature on my passport that I've put onto my phone, if you can aggregate multiple credentials in some sort of user sovereign wallet. At the end of the day, there ends up being some certain metadata and other aspects of aggregating all those credentials that might have to be held on a server somewhere, but it shouldn't be a server. It shouldn't be Google or Apple that knows all of the different identity documents you have and your diploma on your wall, your driver's license in your wallet. It should be a freaking blockchain. It should be completely private, like some of the newer layer 2s like Aztec, or some of the newer layer 1s like Alio. And then you can use zero knowledge proofs as the individual who holds the credentials to selectively disclose to the entity out there who's only supposed to deal with, you know, gated securities transactions, that you are, i.e., an accredited investor. But that entity doesn't need to know anything else about you if we get this right. And there's a huge work stream in digital identity that is waiting to be explored right at the same time that we're thinking about how to, well, not right at the same time, because we were trying to do it a while ago with Aave Arc, but everything old is new again. But right at the same time, it's new again. So I think these two things work absolutely in tandem, and that's one of the most promising areas for the SEC to do good work in this space, is figuring out better ways of gating and permissioning that aren't just this, give us all of your personal information in order to get onto this platform.
Gating and permissioning where the SEC itself leverages the capabilities of the technology.
Exactly.
So not just that the technology creates certain risks, but that it creates certain opportunities aside from what it means in terms of peer-to-peer, peer-to-pool, peer-to-protocol, but it creates other opportunities in terms of compliance, risk management, and the like.
I mean, not only should a bank not need to know what race I am for me to open an account, they should not know what race I am, period, ever. Why? There's no point for it.
Eric, so we've talked about a lot of stuff. It would be great to get your thoughts, whatever they may be, on what we've been talking about since after the break.
I want to suggest that what we see in front of us is actually a really remarkable flourishing of new financial innovation. I want to point out how well the markets are actually solving the problems that have emerged in crypto. For those of you who have been in crypto long enough, you remember Mt. Gox, right? The big exchange, centralized exchange that blew up, almost destroyed the whole industry. What regulation prevented that from happening? Or what regulation from government came out that solved that problem in the future? None, not a single one. You know what did solve it? DEXs, decentralized exchanges, solved that problem because you had open source immutable code that anyone could see. That is a amazing market innovation that does not get enough airtime. I want to point out, let's use Aave again, versus a company like BlockFi. BlockFi was based in New York, and BlockFi abided by all the rules and all the regulations, and much of their marketing was based around how compliant they were. They made sure to KYC all of their customers. They made sure that everyone that worked with them had to hand over their private personal information, and meanwhile, Aave did not. Aave was this, Wild West DeFi application. What was the future of these two things? Aave is still around and processes billions of dollars trustlessly in an amazingly transparent way. BlockFi went bust and lost hundreds of millions of dollars of customer money, right? Which regulation solved that problem? None. None. It was DeFi, it was private markets and people pursuing profit to solve problems, which Americans used to realize was something that the market is supposed to do, not the government. I want to point out that as far as the SEC goes, I want to draw people's attention to what crypto looked like pre-2017 and post. Pre-2017, nearly all of the innovations that we enjoy in crypto happened. This included things like the DEXs and the liquidity pools, the NFTs, which started with CryptoKitties way back then. We had permissionless lending platforms. We had distributed file storage systems. We had Ethereum itself, smart contracts, which are one of the most remarkable financial innovations of all time. We had privacy coins. Everything was booming in 2017. Admittedly, there was lots of fraud and nonsense, as happens on all frontier markets and all speculative cycles. And yet, when 2017 came to an end, 2018 arrives and the SEC arrives. And the SEC completely stamped out most of the innovation that was happening in this space. And I was there at the very front lines seeing the souls getting crushed of the entrepreneurs that were trying to do this stuff. Some of them just gave up. Some of them moved to other countries. And what kind of innovations have we had following that regulatory enforcement? We've had L2s and we've had Fartcoin. This is a very important point.
A thing to add in is if you want to talk about like effective distribution of a token, like Ethereum, just doing a public sale to like nerdy interested developers created a really fair distribution. And Jesus, they raised about $35 million to build that. And look at what happened after people started doing regulatory compliant token issuance. Venture capitalists get all of the tokens and the project kind of withers on the vine despite having massive funding.
Yeah, post 2018, most of the interesting token sales went through more regulated channels and the VCs were the ones that made out.
Yeah, I mean, I agree with all this 100%. It's definitely a factor, but there are other variables beyond just regulation. Like when people bought into the Ethereum ICO, like no one was confident that these things were worth billions and billions of dollars yet. And if an entrepreneur is raising today, I think many times they don't want to just sell to just anyone. They want to get the VCs because there are certain advantages. So it is complicated. Generally agree with the gist of both of what you said, and it's a factor for sure, and it's part of the story of how we got to the current bad place. But there are other factors for what it's worth.
I don't disagree. I mean, sometimes I've found myself saying something that I will admit is quite naive, like, well, just do what Satoshi did. Why do you have to raise money at all? Whoever that person is, they built the most important innovation in the recent history of finance, and they did it with no fundraising. They were able to mine, though, for about 2 or 3 years with no competition, because who in their right mind would start mining Bitcoin in the early days, and who would even know that it was available? Those kinds of early returns on someone's innovation are probably no longer available, because the minute you actually create some new protocol with a proof of work or a proof of stake mechanism, you're going to get out-competed of your own innovation and not actually earn
Greencoin tried a fair launch, right? Proof of work, all the same stuff that Satoshi did, and private equity firms bought off all the miners and dumped the supply, and retail really suffered.
So
it's complicated.
And the SEC certainly doesn't bear the burden of that issue. Yes. But I think it has made it very difficult for folks who are, in good faith trying to do the right thing to take more reasonable steps towards, say, creating some sort of like incorporation between yourselves, or being in your U.S. jurisdiction and cooperating with law enforcement and regulators, because you're just so afraid of this, did you come in and register, or did you get a money transmission license question?
So Eric, I think you now may have some more to respond to. So if you want to,
I'll just end that little tirade by saying that the entrepreneurial spirit, especially when it comes to anything novel, is an incredibly precious thing. It does not grow in hostile environments, and it cannot be planned for. And it is an impulse that is responsible for much of the wonderful things that we have in the world. America became great because, whether consciously or not, permitted that impulse to happen. And cryptocurrency has been a demonstration of that impulse coming back in specifically the realm of finance. The best thing that America could do for itself, for its people, for the world, would be to embrace that impulse and to permit that kind of permissionless innovation to happen again. And that requires permitting risk, that requires permitting harm. It requires letting people experiment without a permission slip. And if America can do that and lead, then I think most other countries will follow suit. So we'll leave it at that.
So Michael Lim, any thoughts on any or all of that?
This is going to be very nerdy take on that, but we've done this before a bit in the prepaid cards world. Looking to my regulatory professors to appreciate, but prepaid cards came out actually in the 70s in Europe, but then the 80s and 90s in America. And for a while, in fact, it was Congress that was pushing FinCEN in particular to regulate. They said there's these cards, they're sort of bearer instruments, but they can be, but it mixes with the online. It's online and offline. What do we do with these? We think there's too much risk. And FinCEN basically took a strategic incrementalism for a long time, actually through the 80s and 90s into 2000. In fact, I think it was, I just looked it up, it was in 2009, finally, FinCEN said, we're going to take action. Congress is really pushing us, but we want to be incremental here. They had extreme engagement with industry, really over a couple decades. And the way they did it was they quantified engaging with industry, what are the major risks here, and working with law enforcement, and then basically set thresholds of activity based on the actual risks that they were seeing, including the ability to, so when you could refill a card, it's a much higher regulatory perimeter. When you can't refill it, when you can only use it in a closed loop system, when you can use it internationally but not domestically, there's all sorts of ways to do it. And I think part of that was getting together with industry and saying, okay, these are the priority risks. To Eric's point, in the meantime, there's a threshold at which we're just going to let people experiment to a certain degree, but we're going to set some priority risks and keep coming down from the priorities, which is actually something that the administration, the last two administrations actually have said repeatedly, even on, especially on illicit finance, is let's prioritize the risks. We can't treat everything the same. So I do think this has been done before, but here there's an opportunity to do it that leverages even more of the technical risk management than we ever had before.
And just to follow up real quick, and then maybe Jill will pose a similar question to you in the 10 or so minutes we have left here for a few more questions. Is one of the risks the risk of stifling the innovation, stifling the technology? I mean, how does that factor? Because you can think about risks in terms of the downside, right? Things that just go badly. You can think about risk in terms of the upside that you lose and how to weight those things in terms of just the judgments. That goes back to some of the points about line drawing and goes back to some of Peter's points about, do you have more bright lines so that folks are able to know with certainty? Of course, that then really presents the line drawing question, but if you do it in an informed way and you know that you're making choices, if you have more principles or standards, there's something to be said for that because there's inherent flexibility, but with that inherent flexibility can come a measure of uncertainty. So you start thinking about the risk, you start thinking about it symmetrically. Losing a good thing is a risk in addition to incurring a bad thing. And then you think about, all right, do you want certainty and clarity and bright lines, even if you run the risk of the line being a little to this or a little to that, you have opportunity to come back and adjust, and at least you have certainty and folks can comport their business and activities accordingly. Is that the kind of thing, or do you have something else in mind?
I think it is risk and opportunity, and part of that opportunity is that you may miss an opportunity to better manage risk. And so I think that's partly why we talked about safe harbors for white hat hackers. Like Jill gave this incredible example of people that were willing to, that actually came in and saved someone's life savings in an otherwise very trustless, permissionless system, that the downside of that is you could lose everything if you send it to the wrong address. But you had people that were able to save somebody, but those people are not going to do that the next time if they're considered a financial institution as a money transmitter for doing that, or if they feel overly liable to cyber intrusion risk from the Department of Justice that says this is technically a hack and we're prosecuting you. It doesn't matter to us that the victim may or may not be on board. And there's a lot of that gray area where people, the white hats, are doing. This is something that Security Alliance spent a lot of time. Gabe worked on this, Rebecca, setting out a safe harbor so that people could do exactly what Jill was talking about and save people in a way that, having been at Justice Department, we didn't want every single person that lost $20 coming into us. We were extremely happy when people would just help each other. There's always plenty of crime. So I think having that sort of ability to, like, that opportunity is the opportunity to keep people from actually helping each other, and that's really important. And I think the last opportunity that I want to highlight that we want to make sure we're factoring in is in the last Trump administration, it was an authoritarian regime in Venezuela, and people were quite sick, and there was no way to get money to these pro-democracy and even just plain healthcare workers in Venezuela. And the way that the government determined to do that, working with the democratic opposition in Venezuela, was they identified healthcare workers in Venezuela that had self-hosted wallets that they could transmit seized funds of the authoritarian dictator that had been frozen and then seized, that they got back to the people of Venezuela who were healthcare workers, only possible in a permissionless system. 60,000 healthcare workers in Venezuela were transmitted to their self-hosted wallets, USDC, in a way that you could never do it. Any fiat currency that the US government sent into Venezuela would just be taken by the central government. And that was a major national security and foreign policy goal of the US that was heretofore absolutely impossible to do other than bags of cash on the tarmac. And who knows where that goes. So I think the opportunity is it's a foreign policy risk, it's a democracy risk, but it's also a risk management risk of that sort of safe harbors.
Got it. So I'm going to, in the 10 minutes we have, I'm going to come to Peter just real quick on a very specific question, then Jill, Kevin, Omid, and then we'll see if we're at.
Could I just 2 seconds just follow up on that? Because you raised a good question, right? It comes down to organizational mission. And if we're talking about the SEC, it is a multifaceted mission. One part of the mission is investor protection, and that should be taken seriously. Another part of the mission is promoting capital formation in the United States. And that's about the opportunity that's lost when there's too much or too harsh regulation. So, I mean, both of these things can be true, and each government entity needs to look to its own mission in terms of making that assessment.
And Peter, the quick question for you, because you had mentioned bright lines and also standards as well. Just I'm curious from your perspective, when you think about all the things you think about, it could be First Amendment stuff, it could just be the practicalities, not just the practicalities of regulation, compliance, et cetera. Do you have a general view in 60 seconds or less in terms of the pros, cons of more bright lined approaches, particularly when it's still relatively early days, which have their certainty, as compared to more principles or standard-based approaches, which have their flexibility, but sometimes can have a measure of uncertainty? Do you have a view or a leaning one way or the other on that?
So where people's liberty is on the line, I want a bright line standard. You know, and that's why the money transmission licensing issue is CoinCenter's top priority, and why the Blockchain Regulatory Certainty Act in Congress is our top priority legislation. Sorry to bring that up at the SEC. It's nothing to do with you all. It has to do with money transmission regulation. But you know, when someone can be found guilty by a jury of a strict liability federal felony for failure to register, I want people to know exactly what kind of conduct they're supposed to register for. I'm also going to say that I don't want certain conduct to be subject to registration, because that could start to become a prior restraint on speech if the thing you're supposed to register for is publishing a software protocol. But on harder questions, like where we have these nebulous concerns about levels of influence or responsibility that people in these systems can use to abuse their users, or can negligently fail to make true their implied promises, their implied warranties, or their explicit promises to their users, I do not think a bright line rule makes sense, because we simply do not know the things we do not know as far as how these systems should be built, what kinds of technological controls should be in place, what kinds of actual agency and discretion for developers or quasi-trusted entities on these networks are good and that we want to see. And so we can't write that as a bright line test. And to me, when I say principles-based regime, I mean the private law. I mean the common law. Because that to me is actually the most principles-based, bottom-up, emergent way of lawmaking. I don't think Congress should be taking action, even if it's to create some sort of cause of action that the private law could be used. I think you want the fraud laws to be used. You want misrepresentation. And these are things that are also within the SEC's jurisdiction with respect to their specific powers over securities transactions. So to me, I would just 100 times over-index on that vis-a-vis DeFi. And to the extent there's anything where you want registration and that there are strict liability crimes for registration, that needs to be a bright line category, because we don't want people falling on the wrong side of that line, surprisingly. And that also cannot be something as simple as publishing a software protocol.
Joe, to come back to the question I had asked Michael M., just the broad question in terms of thinking about lost opportunity and how that weighs in the balance, and it's also the point that Kevin commented on. Your thoughts?
Yeah, thank you. I mentioned earlier, but I'll just reiterate again, we've lost, both as the United States and also as an industry, a lot of great innovators and entrepreneurs over the last 5 or 6 years. And I really hope that that is a point that sticks with those of you who are tuned in or live in the audience here, because that is what is at stake. And I think that we've had a lot of great examples of the potential, but also what crypto has already delivered, mentioned here on the panel today. I would like to see more efforts being put into delivering stable coins into regions of the world where they're most badly needed. But over the last several years, partly because of the SEC, partly because of other organizations like it, not just in the United States, but around the world, that struck fear into the hearts of a lot of the entrepreneurs who were working on these things. Thankfully, there are those brave few who stuck around and continued to work on these very real products and services. But many were driven, again, out of the country, out of the industry, or as Eric highlighted, into other areas of the industry that, if you ask me personally, are much less productive. The meme coin mania has singularly grown out of SEC's policies over the last 5 years. And that is, regardless of what you think of meme coins, in my view, that is a damn shame, because that innovation and that entrepreneurial fire previously was going into the types of products that Michael mentioned, that MJ mentioned, that Gabe has mentioned. So many of the conversations that we've had up here today have focused on, but that fire has at least in part been lost to, again, in my view, less productive entrepreneurial endeavors over the last few years.
Ahmed.
Since we're nearing the end of the conversation, maybe a question that I don't have the answer to, which is that stablecoin legislation is moving forward. The season freeze function of stablecoins is a key part of that legislation. Stablecoins are very prominent in DeFi. If stablecoin issuers start seizing and freezing coins in DeFi, it'll break DeFi. And I think this is, both Gabe and Kevin sort of alluded to this, that we have permissioned or regulated entities starting to really interact with the more native permissionless ones within DeFi. It's something we have to start talking about. And so far the solutions that I've heard are frankly not very good, because they just pit two parts of what the government wants against each other. So for example, the entities that care about illicit activity want the seize and freeze function. But if you're an agency like the SEC, you really care about the stability of DeFi, and you wouldn't want something like Circle suddenly being compelled to freeze $1 billion USDC in an Aave pool to lead to a run on Aave.
Or what if, to plug into a narrative that was current before, Circle decided to IPO, what if someone new acquires Circle and they happen to run a blockchain that competes with another blockchain where billions of dollars of this stablecoin are? Why are they acquiring it? Are they acquiring it just to run a stablecoin business? Or does it give them a hook into their competitor to influence fork choice, which we haven't talked about at all here, but it's a big, big thing, all these things. And, that may be the realm of antitrust. The SEC may have a role, the CFTC may have a role, but the bigger these systems become and the more systemically important they become, the more important these issues and questions of law become.
All right, well, I think we're at time. I think we could talk a lot more about a lot more stuff, but if you'd join me in thanking the panelists, and Commissioner Peirce is gonna bring us home here.
Thank you, Troy, and thank you to the panelists. I thought this was a fascinating discussion. It shows we need, we're not done yet, really. There are a lot of unanswered questions still. But I think it is encouraging to know that we can make progress. We talked about sometimes the community in a protocol says to the founder, we're taking it over from here, we're gonna do something different. And I think this is a time for the American people to say to its regulators, you know what, you really messed up and we wanna take it in a different direction. And so now let's figure out where to go with that. I think there's some promise, there's a lot of risk, I think, that we talked about. Those risks manifested themselves in people leaving the US, spending their time on less productive things than they otherwise would have. But there's also promise, I think, in the sense that we as regulators should remember that a lot of problems are problems that we don't have to solve. We just have to give people the room within which they can solve those problems, and then we can focus on the ones that regulators are uniquely designed to solve. And so some of that there is stuff that we can take off our plate, and I think that's encouraging, and then we can all try to do a better job with what's on our plate, and more interactions like this are gonna be very valuable for us in that. So Troy, I know you've put in a tremendous amount of work in preparing for both this roundtable and the first one. I appreciate it. We all have lots of work ahead of us. I do invite people who have thoughts on these things to take a look at our website. If you go to the SEC's main website, sec.gov, there's a tab there for Crypto Task Force. There are different ways you can interact with us there. We do welcome people's feedback. You can provide written input. You can come meet with us. And so I'm looking forward to further input from people. I have to thank, before we end, just the dozens of talented and committed commission staff in the chairman's office, other commissioners' offices across the commission, the Office of Information Technology, Public Affairs, Secretary, Chief Operating Officer, Office of Financial Management, and many others. And then on the Crypto Task Force, it's a wonderful team that I work with. They do so much, not only to make these roundtables happen, but to actually get to more crypto clarity. So thank you to them. But for the roundtables specifically, Samira Yunus, Ileana Chobano, Landon Zinda, and Robert Tepley have all put in tremendous amounts of time on getting these task force together. So thank you. And they've always approached it with a mix of levity and organizational genius, which is a good combination. Thank you all for attending, whether here in person or online, and please stay in touch. Thank you all.
Alrighty, guys, that is the conclusion of the long roundtable today. Some interesting points. I definitely took some notes. I'll probably integrate some of that stuff in some future videos for you guys, but I appreciate you rocking with me here for a while. It's been a long stream, 4+ hours, and we had a little intermission there, hung out for a long time here, but it was good. You know, it's good for us as retail investors to stay up to speed on all this, and appreciate you guys being here. If you're not yet subscribed on YouTube, not following me on Rumble or X, make sure you guys do that. Really appreciate all you guys so much, and I will talk to you guys very, very soon. And again, be on the lookout for a bunch more content right here on the channel. Follow me on X. We do a live space over on X Monday through Friday, 9:30 to 11:30 a.m. Eastern. So yeah, it's always an amazing time. So make sure you come check that out as well over on X. Follow me. You can find that linked either on my Rumble or YouTube over on X. So again, Monday through Friday, 9:30 to 11:30. We're going to be doing a lot more live streams like this as well to all three platforms. So appreciate you guys so much. And 4 hours and 20 minutes into the stream, we got to shut it down right here. It's got to be 4:20, right? This is crypto. So I got to shut it down in the next 30 seconds because, you know, for the memes. Appreciate you guys. We'll see you guys in the next one.